Okay, looks like we have our attendees for now, so I think let's get started. So, welcome everyone to this full afternoon of training on applying the IFRS Sustainability Disclosure Standards. This program is truly a collaborative effort, really driven by that demand we're seeing in the market for more engagement and capacity building on the IFRS Sustainability Disclosure Standards. So firstly, we'd just like to say thank you to our co-facilitators of this training, the IFRS Foundation, for their partnership on this programme, as well as IFC, our partners on this training as well. And of course, a big thank you in particular to the Armenia Stock Exchange for hosting this session with us today. It's great to have your involvement. And finally, of course, to all of you who've joined us to participate in the training, thank you very much for taking the time to be with us. We really appreciate you joining us here today. So I'll be hosting the training from the SSE team. I'm Fiona Quinlan-Wells. I'll be introducing some of my colleagues from the IFRS and SSE who'll be delivering the training together with me later. But before I do so, I'd first like to turn the floor over to Irina, who joins us from the Armenia Stock Exchange, and she is the Head of Business Development at the AMX. So Irina will be just giving us a few opening remarks. So thank you very much, Irina, and the floor is yours.
Thank you, Fiona. Good day, dear colleagues. It is very nice to see so many local and international professionals interested in better understanding and subsequently application of IFRS sustainability disclosure standards. The key here, of course, is understanding the immense value that practicing the concept can bring to your organizations, including in such important matters as heightened investor interest, as well as internal corporate strategy processes and resilience enhancement. Understanding on our side that stock exchanges have a big role to play here as well. As a subsidiary of GPW, Armenia Stock Exchange AMX considers it our most important responsibility to disclose relevant sustainability related information, to also be included in GPW's annual management report. And of course, before we get started, a huge thanks to our trusted partners from UN Stock Exchange Sustainable Stock Exchange Initiative for organizing yet another wonderful learning opportunity for AMX, our partners, and of course, AMX members. Thank you, and looking forward to the interesting content today.
Great. Thank you so much for that, Irina. And it's our pleasure to be here with you virtually. Excellent. Thank you so much for that. So that brings me then on to a few practical points that I'll cover from my side just to explain how today's session will work. So as you've probably noticed by now, you are muted in the training. That's just simply to allow us to move through the training content because we've got quite a lot to cover, as you'll see in the agenda. However, that really isn't to say that we don't encourage your participation. So please make sure to use the chat function throughout if you'd like to share any comments, or if you want to say a little bit about the context for how your organization's approaching something that we discuss. And then secondly, you have the Q&A module within Zoom as well. So it'd be great if you could make sure if you have specific questions that those go into the Q&A box as opposed to the chat. And that just ensures that the team can keep track of those questions and can get back to you with their answers. And so a few more things just to say is that the session, as you probably know, is 3.5 hours long, is the live training. And we do have an optional follow-on homework exercise to help you continue your learning, which we'll share more about later in the training. As I've mentioned already, we have the Q&A that's live throughout the session, so please do make use of this opportunity. We have a number of experts from the IFRS Foundation here with us today, so definitely make sure you get the questions asked that you'd like to know answers to, and we'll be able to respond to those throughout the session. We do, of course, as well ask for your participation and engagement in the training. So we're going to be doing a number of interactive elements, including using Menti and the polls. So we'd really encourage you to take part in those exercises as well throughout the training. And finally, as you might have seen already, you are eligible to receive a completion certificate if you take part in today's live training. And to receive that certificate, you'll need to complete a feedback survey, which we'll share with you at the end of the session. So stay tuned later on in the training to hear more about how to receive that certificate. And just to introduce who's going to be delivering the training today. So as I've mentioned, I'm Fiona. I'm an SSE training officer at the Sustainable Stock Exchange Initiative, and I'm joined by my colleague Lois Guthrie, who is our senior specialist. And with us from the IFRS Foundation, we're joined by Bella and Robert from the capacity building team. And so in terms of our learning objectives for you from today's training session, so we have three key areas that will help you be able to take away from the training. Firstly, it's to understand the ISSB standards. What are they all about and what's the content that sits behind them? Secondly, we want to help you to understand how you can use and apply the ISSB standards within your organizations or contexts. And finally, we want to help you identify the steps that you can take to develop your own disclosure plan to start applying the ISSB standards. And so to help us work through that structure of those learning objectives, we've broken the training down to simplify it and really take it step by step. So we have those 4 modules that you'll see on the screen there that we're going to be working through in a sequential order. So firstly, starting with our module 1 on prepare, this is all around understanding and building on existing knowledge that you might have of sustainability reporting. So what is its purpose? What's the overall landscape that's evolved of frameworks and standards? And how has that led to the global baseline of the ISSB standards? Secondly, we'll move into align. So this is thinking about setting the direction for your reporting, thinking about how you can apply and use the ISSB standards, and maybe some additional disclosures that you might need to add relative to what you've been reporting previously. That'll then take us into our third module, implement, and this is all around the practices and systems that will support your reporting. So thinking about how you can identify, evaluate, and integrate sustainability risks and opportunities, not just into your disclosures, but into your business decision-making as well. And finally, we'll round things off with our last module, communicate. So as you've guessed it, this is all around the final format of your reporting, where to report, when to do so, and how to do so efficiently and with confidence. And so to help us work through those 4 modules, here's just to show the structure of how we'll break this down. As you see, some modules are larger than others, so we'll spend quite a lot of time in particular around align in module 2. And we will have a short break in the middle of the session as well. We know it's a long time to be concentrating online, so we'll just take a brief moment in the middle to stretch, refresh, etc. And then at the end of the session, we'll close off with some takeaways and talk you through the homework and some additional resources to support your onward journey in reporting. And so just to mention a few things that we're going to cover and come back to throughout the training. So firstly, it's just to say that all of the materials from today's session, and that includes the slide handout that I'm presenting now, the homework assignment that you can optionally do in your own time, and the hyperlinks to a lot of the resources that we're going to be sharing with you can all be found on the event webpage, which my colleague Lois has just shared the link to. Thanks, Lois, in the chat with you there. So we'll share that link again a few times, but if you go to that page, you'll be able to download the slides, find the links to the resources on the slides, and also to access that homework assignment. And following the training session as well, the recording for today's training will also be added to that page as well. And as I've mentioned, we do have a homework assignment that you can access from that event page. Really, the focus of the homework is to help you to continue to develop this disclosure plan we're going to be talking about today for your organization. So it isn't mandatory to do this exercise, and it isn't mandatory or necessary to submit it to us, but it's just something that you can optionally take away to continue to support you to work and start your conversations internally for this reporting. So you'll find the link to that, as I mentioned, at that page there that Lois has shared with you. So if you go to the bottom on resources, you'll see the link to access that. And then just to mention a few sort of key resources from the SSE side that we encourage you to take a look at. So you'll see the QR code to access these, and you can find them on the SSE website as well. But we've developed a few different toolkits to really support you in your disclosure journey on the ISSB. So firstly, we have our model guidance on sustainability-related financial disclosures. So this is aligned with the ISSB standards and all about helping you to practically implement them within your organization. And then if you want to know more about some specifics relating to climate, we have some particular tools on transition planning and climate-related metrics as well. And finally, a checklist or gap analysis toolkit on the sustainability-related disclosures of the ISSB to help you understand where your gaps might be and plan how to address those. Okay, so that just gives you a little bit of an overview of some key resources there and some things we'll be coming back to. But to get us started, we'd love to hear from you firstly and to get into our first Menti exercise, a good test to make sure you can access this because we're going to be coming back to Menti throughout the training. So we have a link that's just about to be shared with you in the chat box, which will take you directly to the Menti assignment. Thanks for sharing that, Lois. So if you click that link we've shared in the chat, you can go directly to the specific Menti we're going to be using. What I'm going to do now is I'll share screens with Menti, and that's also going to give you a couple more ways that you can join us as well if you'd like to take up those options. So firstly, as I said, you can use that link we've already shared with you, but if you would like to, you can also go to menti.com and enter that code that you're now seeing at the top of the screen there, so that 8-digit code. And you can also, as a final option, use that QR code that you see in the bottom right of the screen as well. That will take you here. So as a few of you have already spotted, our first question for you, just to get things started, is to understand in your own words what you've joined us for here today. So just tell us in a couple of words what your reason is for joining us here on the training. Great. I see a number of you have found us and have taken part. So I see some of you have mentioned, obviously, thinking about climate change in particular, building your understanding and knowledge, maybe helping you to comply with the ISSB standards, gain some insights into trends in the market, understanding the general kind of context. So yeah, lots of things I think that are quite relevant to what we're going to be covering in the training content. So I hope those are all areas that you'll be able to come away from today feeling better equipped to take forward. Great. Okay, it's a good test. I see lots of you have been able to access this now. I should say, if you are having, for any reason, difficulty, you are welcome to share your responses in the chat as well with us if you'd like to do so. But hopefully with those 3 different options, most of you have been able to get into the Menti now, which looks good. Great. Thanks everyone for sharing. So what I'll do is we've got one more opener question for you. So I'll just move on to that next question. And this is just really related to those learning objectives we talked about at the start of the training. So thinking about how comfortable you are with each of those tasks that we talked about. So firstly, explaining to your team what the ISSB is, in using the ISSB standards, and in developing a sustainability reporting strategy. So if you take a moment to let us know from the left-hand side being that you're not comfortable or not familiar with these areas currently, and to the right-hand side of the scale being that you're quite familiar and you kind of know these areas already. Just good to test, where we're at today with these current kind of understanding of these different areas. Okay, so it seems as though we've got a little bit of a mix, but for the most part, we're kind of in the middle to lower end of comfort at the moment, which of course is very understandable considering you're joining us here on the training today. But thanks for letting us know. And of course, that's something we hope when we come back to check this at the end of the session, we can hopefully have moved a little bit further along that curve. Okay, so that is all we do in Menti for now, but I'd encourage you to keep that Menti tab that you've opened there in the background. And what we'll do is we'll return to that later in the session for some more exercises. But I'll just reshare the slide presentation with you now. Okay, so to start us off, I'm going to be covering just a few of the introductory parts in the first module. So first, before I start that, I have a little disclaimer that I'll just share with you on the screen there for you to take a moment to review. And what we wanted to be clear with you here is we're going to be talking about a number of company examples in the training today. And these are really simply there to help add some colour to what we're talking about. Sometimes we know it can help to see a real example to put into practice the theory of what we're talking through. But of course, the examples here shouldn't be seen as the best or the right way for you to approach these topics. Of course, this is very individual to each company's circumstances, and you really need to do what suits you best. So please take these as inspiration, but not as necessarily an endorsement or indication of the right or best way to approach this. Okay, with that established, as I said, I'll be starting us now in module 1. So as we said, this is prepare really around building that solid foundation of knowledge and building on what you might already know about state sustainability standards and frameworks. So generally here we'd like to cover 3 important aspects. So firstly, why you should disclose sustainability information. Then we're going to think about how the landscape of disclosure standards has evolved to reach the development of the ISSB standards. And finally, we'll introduce an overview of the standards themselves, that global baseline, and set some of the core concepts and requirements that sit within the IFRS S1 and 2 standards. So to get started with the why aspect, we're going to be looking at purpose. So thinking about what's really driving the case for disclosure and what might be happening in the market to influence companies in this case. So to get us started with that, we have a quick poll question for you here, just to get a gauge of what some of your key drivers are. So I'll launch the poll for you now, which hopefully should be visible. If for any reason the polls don't appear, which we know occasionally happens, feel free to share your answers in the chat with us as well. Let us know quickly in the poll, as many of these are relevant for you, what your key reasons are for disclosing or wanting to start disclosing sustainability related information. Okay, great. I see lots of you starting to participate in the poll. We always like to get as many of you taking part in the polls as possible. It, helps to keep it lively and engaging. So please do try and take part if you can. It's always good to see what is different as well between different markets, because things can differ a little bit as well. And if you have any context that you want to share with anyone in the chat about your perspectives on these, feel free to do that as well. We're a relatively small group today. We're just over 100 of us. So we have, I think, enough space in the chat to share a little bit more as well. So do take advantage of that while we're participating in the training. Okay, I think we have nearly 60% have taken part. So I'll end the poll there and share those results with you. So we can see here, I think, a fairly even split, kind of around half of you have highlighted either regulatory requirements or investor interest as key drivers for your sustainability reporting. And I think that's a very common picture across the markets that we work in on this training. But we also see a reasonable number of you highlighting that maybe you want to share your own management's objectives or respond perhaps to competitor or peer pressure on these topics as well. And I know some of you have highlighted that maybe you're not starting yet on sustainability reporting, and of course that's fine as well, and hope we can highlight today some of the reasons why it might be beneficial to start your reporting journey. Great, thanks for sharing that though. So we'll close the poll down there. You may need to close the screen on your side as well, just to see the slides again. But I'll just start us off with a little bit of context setting around some of these areas. So I know many of you there did highlight investor interest in this as a driver for you. And I think we'd really highlight that this is a very consistent theme that we're seeing across markets now. So now we have more than 5,000 signatories representing 128 trillion US dollars in assets under management who have signed up to the principles for responsible investment. So I think this is just a really key indicator of that growing investor interest and focus on ESG and sustainability. And so what is it that's really driving this interest from the investor community? So what I think is important to highlight here is that a key driver behind this demand is the financial effects of ESG issues. So this isn't that investors maybe are necessarily purely altruistic or just want to have an impact. Of course, they might want to do that, but actually, I think increasingly the financial relevance of these factors are recognized as well. So here we just have a small study from Morgan Stanley, which looked in particular at individual retail investors. But what they found here was that the top driver of at least individual investors that was driving their focus on sustainable investing was actually the financial performance of sustainable investments. So you can take a little bit more look at that data in the handout if you want to follow the link to see more about that. But let's look a little bit closer before we move on at what we mean by financial performance. So it's important to remember in today's training session, we're going to be talking about financial materiality and financially material sustainability related information. So whilst we're going to discuss in more depth later in the workshop what we mean by material, we wanted to be a bit clear up front on the sorts of financial effects investors are looking to focus on and understand better in your disclosures. So firstly, starting with the effects on the company's performance. We often see this reflected in the profit and loss or income and revenue statements. So sustainability-related risks and opportunities can have a financial effect, perhaps by changing the revenue mix or total revenue of a company, if demand for products and services might change, or if production capacity might be disrupted, for example. And we can also see substantial changes in expenditures if, for example, operating costs increase due to energy prices increasing, or a need for greater R&D expenditure to capitalize on sustainability-related opportunities, or other costs associated with deploying new practices as well. So they're just a few examples of some of the ways in which sustainability risks and opportunities can directly affect a company's financial performance. And so you'll also probably hear us talk today about effects on a company's financial position. So let's also look at what we mean there. So we often see a company's financial position on their balance sheet or their statement of financial position. So for example, a company might experience changes to certain assets or liabilities due to climate or sustainability issues. We could see changes to portfolio value. We could even see write-offs of certain assets that perhaps are damaged or need to be repriced for sustainability risks. And another financial effect that needs to be documented is changes to financing and costs of capital. So example of this could be that insurance premiums could increase due to climate risks, or conversely, we might actually have access to new financial structures, such as green bonds or social bonds. So there again, just a few examples of what we might mean here by impacts on financial position. And then before we move into the next unit of this module, I just wanted to flag two important aspects on sustainability-related risks and opportunities, which are really essential to understand before we move into talking about these topics in more detail. So you're probably familiar with this visual from the World Economic Forum's Global Risk Report, but what we want to highlight here is that risks can really evolve over time. So what might be front of mind today as a key risk or opportunity could change significantly in 10 years' time. And what's important for our disclosures as well is that we're preparing for those risks that we're expecting to see over maybe a 5 or a 10-year time horizon. And of course, we could indeed see financial effects on your performance and position today as a result of those long-term risks. So for example, if we have to take action to mitigate a potential future negative risk, those financial effects could be felt on a sooner time horizon. So that's worth keeping in mind as we move through the training today. And a final key point I just want to highlight in the introduction is the interconnectivity between sustainability risks and opportunities. So here in another visual from that WEF report, we see sort of a mapping of how different risk types are connected. And as you can see here, of course, there are many different interconnections. And so when we're thinking about the S1 on the general disclosure side and the S2 on the climate disclosure side of the ISSB standards today, it's important to remember that these issues, of course, are very much interconnected despite being separate reporting topics. So when we're starting to think about how we can disclose, we really need to try and consider the whole as best as we can and think holistically about how to interconnect these risks and how to deal with them in a consistent and interconnected way. Okay, so that's a few key concepts I wanted to highlight to get us started with, but I'll now be handing over to Lois, who's going to get us started with the landscape side of the session.
Thank you, Fiona, and hello, everyone. So Fiona has explained to us why sustainability disclosure is important. So we've covered why, and we're now going to look briefly at how the IFRS sustainability disclosure standards have been developed within the landscape of existing reporting standards. But before we go into that, we'd like to do a Zoom poll with you to ask you which frameworks you are currently using. So you can select all that apply in this Zoom poll. So if you are currently making sustainability disclosures, which frameworks are you currently using? CDP, formerly the Carbon Disclosure Project, or the Global Reporting Initiative, Integrated Reporting, the Sustainability Accounting Standards Board, the Task Force on Climate-Related Financial Disclosures, the UN Global Compact's principles, or maybe something else. And if it is something else, please do tell us in the chat. Just give you a moment to give you answers here. Thank you all for your participation. In the interest of time, I will just end the poll and share the results with you. And you can see that there's quite a spread here. The majority, 31%, using the Global Reporting Initiative, closely followed by integrated reporting. And we can see that people are using others. Perhaps you can indicate to us in the chat as we go along, but GRI, integrated reporting, TCFD seem to be those that you are using most often. So thank you very much for sharing that. Helps us to understand how you are currently reporting within the landscape. So let's move on now to think about what is the IFRS Foundation and what is the ISSB. Saw in the Menti we did earlier that only about half of you, I think, were confident to describe the ISSB. So the IFRS Foundation, within which the ISSB sits, is a not-for-profit public interest organisation that was established to develop high-quality, understandable, enforceable and globally accepted accounting and sustainability disclosure standards. So at the bottom, we can see the two independent standard setting boards that are hosted within the IFRS Foundation. And they are the International Accounting Standards Board, IASB, that was formed in 2001, and the accounting standards issued by the IASB are in place in over 140 jurisdictions around the world. The International Sustainability Standards Board, the sister standard setting organisation, was formed in 2021 and it released its first two standards that we'll be talking about today in 2023, following a strong market demand for its establishment. Now, because these two standard setting boards are both within the IFRS Foundation, they work very closely together to ensure that their standards complement each other. Governance of the standard setting boards is provided by the IFRS trustees, Foundation trustees, and they in turn are accountable to a board of public authorities who provide the monitoring of the standard setters and the trustees. So how did the IFRS Foundation and the ISSB, how did the standards develop? Well, on this screen, you will see a number of logos with which I'm sure you're familiar. So it looks like a fairly complicated picture, but actually the main message to take from this slide is that we're seeing the evolution of reporting standards become much more simplified and harmonized. And that's what these arrows point to. So I can see some of you saying in the chat that you already use the Transition Plan Task Force a disclosure framework, for example. And you can see that the arrow shows that the TPT's work, to the extent that it covers disclosure-specific materials, has now been taken over, or it's now being managed by the IFRS Foundation. Similarly, the TCFD, Task Force on Climate-Related Financial Disclosures, its work has come to a culmination, to an end, and the work of the TCFD is now managed by the International Sustainability Standards Board. You can see that 3 of the organisations in the landscape, including the Integrated Reporting Framework and the Sustainability Accounting Standards Board, their work has been consolidated into the IFRS Sustainability's work. On the right-hand side of the screen, CDP has aligned its climate questionnaire with IFRS S2 on climate disclosure, and the GRI is working very closely with the IFRS Foundation to ensure that disclosures are as aligned as possible on common content elements. So a picture of harmonisation and simplification. Let's go to another Zoom poll now to think about what this means for companies already disclosing using the TCFD recommendations. You can only pick one answer here. And the question is, companies that disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or is this false? I'll give you a moment to think about that. Thank you. I can see we've got 50% participation now. And so I'll end the poll and share the results with you. And you can see that 56% said it was false, 44% said it was true. Well done. You got it right. It is indeed false. Now, if you do use the TCFD recommendations currently, you will be a long way towards conformance with the ISSB standards, in particular S2 on climate disclosure. But you cannot assume that because you use the TCFD recommendations, you automatically comply with the ISSB standards. And we'll have a look as to why that is now. So on the left-hand side of the screen, you can see a little picture of a report that the ISSB has done that compares IFRS S2 on climate-related disclosure with the TCFD recommendations. We know the TCFD's work has now finished. I'm sorry about this. And so they've taken over responsibility for the TCFD monitoring. So this little document, it compares IFRS S2 and the TCFD, and it shows that there are 3 main differences. The first is sometimes different wording is used, but actually it means the same thing. The second thing is that sometimes S2 requires more detailed information than the TCFD. So, for example, might be more detailed information on the use of carbon credits than was required by TCFD. And thirdly, S2 has some additional requirements and guidance. And an example of that would be the requirement that companies should consider sector-specific disclosures when making their reports. So let's move on now to think about the objective of the ISSB. Their main objective was to set a global baseline for sustainability information. And that global baseline would provide a common language for comparable, decision-useful disclosures to be provided to global capital markets and investors within them. But because there is a global baseline, what can be added to that, as we see in the little illustration on this slide, is building blocks. And those building blocks mean that jurisdictions can add specific requirements to the global baseline, perhaps in line with jurisdiction-specific policy requirements, or they can add requirements that serve the information needs of broader multi-stakeholders. I'm so sorry for my phone going off. I don't seem to be able to stop it online. So taking this building block approaches, it reduces the need to duplicate information by having the globally consistent baseline of disclosures, but still allowing information to be reported for a wider stakeholder group according to GRI requirements, for example, or according to the needs of the jurisdiction. And those additional disclosures can be provided as long as they don't obscure the information required by the ISSB standards. So just to let you know, there's been global backing for this approach for the global standard that's reflected in the standards that the ISSB has issued. The International Organization of Securities Commissions has announced its endorsement of the ISSB standards and asked their 130 members around the world to consider how they can incorporate those standards into their regulatory frameworks. We see some emerging assurance standards. So you've probably seen that the International Auditing and Assurance Standards Board has developed sustainability assurance standards to support sustainability disclosure. Jurisdictions around the world are thinking about how they are going to adopt the standards, and in some cases the commitment has been made. And also there are exercises like this training to help market participants decide how to voluntarily apply the standards in particular jurisdictions or circumstances. So let's get on to the standards. I'm going to hand over to Bella, who's going to start to explain to us IFRS S1. Over to you, Bella.
Thank you so much, Lois. Okay, so let's continue with the ISSB standards. Okay, we've talked about the business case and the market case for sustainability reporting, the evolution of the landscape, and how it is being simplified and rationalized. Now let's introduce IFRS S1 and S2. As we start, it is important to note that there are some key terms that should be understood. You can find the definitions in your handouts, but I wanted to briefly mention them here. First of all, we will be saying the phrase sustainability-related financial information quite a lot. This can refer to a broad set of issues, including climate, nature, or biodiversity, human, social, or others. In terms of sustainability-related financial information, it is information about a company's sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. What do we mean by sustainability-related risks and opportunities? They are risks and opportunities that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. It could affect the company's prospects. We will also often refer to general purpose financial reports, which includes a company's financial statements and management commentary. You might know this as a management report, management review, or strategic report. Some regulators require specific disclosures in certain parts of general purpose financial reports, so we use this generic phrase throughout. Anyone familiar with TCFD will recognize the same 4 core pillars or content areas for the ISSB standards. These are governance, strategy, risk management, and the metrics and targets. For each core content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the 4 content areas today, but I encourage you to download the standards as part of your homework assignment. Okay, so let's start with IFRS S1. Altogether, its full title, general requirements for disclosure of sustainability-related financial information. IFRS S1 sets out general requirements for the content and the presentation of sustainability-related risks and opportunities. If you are familiar with TCFD, you will see the same architecture applied through all the standards. S1 asks preparers to refer to and consider the applicability of the ISSB standards and the other sources of further guidance to identify sustainability-related risks and opportunities and identify material information. The ISSB standards are organized by industry, enabling a company to identify disclosure topics and the metrics applicable to its business model and operations. So in IFRS S1, the standards can be used in conjunction with any accounting requirements, as stated in the last line of this slide. Okay. The scope of S1 is all sustainability topics except for climate, which is covered by S2. So the second standard, S2, focuses on climate disclosures, building on the same foundations of S1. For example, it fully incorporates the recommendations of TCFD. It also sets out the requirements for a company to disclose material information about its climate-related risks and opportunities. And it also requires the disclosure of both cross-industry and industry-specific information. In terms of climate-related risks, this includes both physical and the transition risks, which we will come back to later. Other specific climate-related disclosures are required, for example, on scenario analysis and GHG emissions. Preparers must also refer to and consider the applicability of the industry-based guidance on implementing IFRS S2. As we've said already, this is organized by industry, enabling a company to identify climate-related disclosure topics and metrics applicable to its business model and operations. So it's important that S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risks and opportunities, the company must apply both IFRS S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of information that needs to be provided in order to be decision useful for investors. IFRS S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. So next, let's consider some of the conceptual foundations that underpin the ISSB standards, which might be new to anyone without an accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. So to start with, companies must fairly present a complete set of sustainability-related risks and opportunities. And fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. And the reporting entity concept requires the organizational boundary for sustainability-related financial disclosures and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISSB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the four content areas, and connections between sustainability-related financial disclosures and the main financial statements. Okay. So it's time for an example in terms of connected information. So over to you, Lois.
Thanks, Bella. And just to repeat the disclaimer that Fiona gave earlier, because this is our first example, we show you the examples today by way of inspiration rather than to suggest that they are our best practice. So if you could bear that in mind, that would be great. Now, as Bella just told us, connected information is one of the principles and requirements of the ISSB standards. There are lots of things that could be connected, the risks and opportunities, as Bella said, financial statements and the sustainability disclosures, the different content elements that we're covering today. But in this example, we're looking at the way in which a company called BHP has made disclosures about some connections in an extract from their 2024 annual report and the operating and financial review section of that report. So this is part of the report in which BHP describes how it manages climate-related risks and how it plans to transition to a net zero economy. And this extract, as the title shows us, describes the impact of the company's climate-related risk assessment and climate scenario analysis on their business and capital allocation plans. So what do we see being connected here? First, in the first paragraph, the extract tells us that climate-related risk assessments and scenario analysis are integrated into the company's strategy and treated as a sensitivity in their capital allocation process. This means that they can test the connections and alignment between the company's strategy, its capital allocation plans, and a rapidly decarbonising global economy. That's the first thing. This extract also tells us that some assessments are still in progress. So the company in the second paragraph is telling us about the studies that they're undertaking to assess the effect of future physical climate-related risk on the company's operations productivity and costs. So they're going to use those results to inform updates to their risk profile, corporate planning, controls and adaptation measures. So we can see how there's a connection between work in progress on their physical risk assessment and how they're going to integrate that then into existing processes on risks planning, controls and adaptation. At the bottom, you can see some grey text, and this tells us where we can find connections to further information on the impacts of climate-related risks on operational activities, on greenhouse gas emissions, across the value chain, on the financial statements and production, and on revenue and expenditure. So this little extract is just one example amongst many others in BHP's report about how the effects of climate change are connected with decisions, plans, and so on about how climate affects business operations, risks, controls, finance, and strategy. Back to you now, Bella, for a Zoom poll, I think.
Thank you, Lois. Okay. Yes, you are right. It's time for a Zoom poll. So let's do a test on the core concept of connectivity now. So the question is, what information should be considered for connected information? So is a connection between governance strategy, risk management, and metrics and targets? all connections between sustainability-related financial disclosures and financial statements, all connections between sustainability-related risks and opportunities. So just a reminder that this is a multiple choice, which means there's not only one correct answer. You should choose all the answers that you think is right. Okay, so let's wait for a few more seconds. Okay, so I'm going to end the poll and share the results. Yes, as you can see from the results that 70% choose option A, and 59% chose the option B, and only 30% chose the option C. Well, the correct answer is all of the three are correct, so you should choose all of them. So I think the reason that the option C is the least choosing rate, maybe is because someone think this is a single choice question. But just remember that in terms of connections or connectivity, connected information, all the three apply. Okay, so let's continue. And finally, the standards are built on the concept of materiality as defined by the IFRS Foundation. We are going to go into this in more detail later, but just to highlight that we'll be referring today to material information, which is information that if omitted, misstated, or obscured, could reasonably be expected to affect investor decision-making. During the ISSB consultation on the exposure drafts, one of the key feedback topics was the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and the application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including the IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The ISSB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the IFRS credential was also updated with more planned to come. I should also note that the IFRS Foundation's capacity building program, which was launched at COP27, is a key part of our support to preparers, and the SSE training initiative is one of our most important deliverables. Okay, so it's time for another Zoom poll. Yeah. So the question is, water is a vital input to your business, but the ISSB standards do not currently have a specific standard on water. What do you do? And this is a single choice question, so which means there's only one correct answer. Okay. Wait for a moment to get more participation. Okay, so I'm going to end the poll and share the results. Okay, So you can tell from the results that 71% participants have chosen option B, which is consult the sources of guidance listed by ISSB. Yes, this is the correct answer, and I think a majority of the participants have answered correctly. Yes, as I just mentioned in the IFRS S1, it requires us to refer to and consider like ISSB standards and the other sources of standards. When identifying the sustainability related risks and opportunities and material information. So obviously, option A, do not disclose anything about water, is not correct. And maybe many of you may think option C and D may also be helpful, but for this question, only option B is correct answer. Okay, so this is the end of module 1. Over to you, Fiona, for the summary.
Great, thanks so much, Bella. Brilliant. So as you say, that brings us to the end of our first module. So let's wrap this up with just a few minutes to review what we've covered so far. So firstly, we reviewed the purpose of sustainability related disclosures. And a key takeaway we hope that you'll leave this workshop with is that there are important benefits for disclosure, both internally and externally. So both reporting this information publicly and using it within your business are really important to really maximize the benefits of this exercise. And if you're not really aiming to make good use of that data that you're collecting to improve your own strategic decision making, then ultimately you're wasting an opportunity. And if you have operations in difficult to abate or high impact sectors, your competitors may well already be disclosing their risks and opportunities relating to those. So that would leave your investors potentially wondering why you're lagging behind, which could start to affect your engagement and access to capital in the long term. So better to get ahead of that and communicate clearly what you're doing about these issues. And next, we looked at the evolution of disclosure standards. So the formation of the ISSB and the aim to simplify the reporting landscape. And when you're thinking about other voluntary disclosures, you shouldn't see them as competing with the ISSB standards, but rather building on top of that baseline that they set. And finally, we introduced the standards and important concepts you need to understand in order to use them correctly. So a key point I want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors as the primary users. And so they're heavily focused on those prospects that we discussed at the start of this unit relating to financial effects and performance and position. Okay, so that just recaps a few of those key points from module 1. And we're going to wrap this up now with a little bit of an exercise to get you thinking about how to reflect this in your own organization. And we should say that each of these exercises also corresponds to the content in the disclosure plan homework handout we talked about. So you'll be able to use that homework to further build out your thinking and your draft disclosure plan in these areas. But today we just want to start the ball rolling really and think about some ideas together. So our first question for you in the exercise is to think, how are you going to define the objectives for your sustainability disclosures? So we've talked here that it's really important to set clear goals for your reporting and to be clear about the benefits and opportunities that you can have beyond perhaps just meeting a regulatory compliance requirement, although of course that's obviously very important as well. So here we'd encourage you to think about defining what the requirements are that you're seeking to meet and what the different objectives are that you're aiming to achieve here. So I will now again take us back into Menti to have a little look at this together. So I see some of you have already accessed Menti. I shared the link again in the chat earlier, and it's the same as the link we had before as well, if you already had that open. So you should be able to take a moment to see and respond to that question. And then I'll just share my screen again for Menti so that we can see together your responses coming through. Brilliant. Thank you, those who've already responded. So I see we have some mentions here of objectives relating to achieving regulatory compliance and increasing investor confidence and customer trust. I think that's a great triad of things to consider there. So, as you say, you can really build that confidence in your investors through transparency, demonstrate how you're managing these risks and identifying opportunities. And also, if it's something, as you say, that your customers are interested in, really important to galvanize those benefits that you can get from sharing more disclosure with them as well. And then I see we have, so using sustainability disclosures to achieve transparency, accountability, stakeholder engagement, risk management, compliance, standards adherence, and continuous improvement. So yeah, a really great set of areas to consider there. I see several other people have also mentioned transparency and accountability in their responses. And also, I think, as you say, they're highlighting competitiveness is really key. So actually, you know, what can the competitive advantage and differentiation be for your organization about, you know, putting this information out there? So let's see what else we've got. Driving responsible business practices, I see mentioned. So yeah, you know, not just thinking about what goes out into the world, but how you can take that information back internally to change your internal processes, of course, is key for having an impact and managing these issues. Okay, so aligning with the standards, of course, integrating sustainability into strategy. I think that's a nice point to highlight there because, of course, you know, we're speaking here in much the same language as strategy, financial performance, etc. So interconnectedness between your disclosures on sustainability and finance and your internal strategies and governance is a really key aim with these initiatives. So definitely something that's important to keep in mind. Just scroll a little bit more, see what else we've got. Lots of really thoughtful responses here. So thank you everyone for taking the time to share, and I hope it's helpful to be able to reflect together and just bring together some of the thinking so far. So being understandable for stakeholders, winning their trust and building effective, constructive relationships. Yeah, that's a really good point. Okay. Potentially attracting investors as well, indeed, you know, actually potentially new investors, foreign direct investment perhaps, for example, could be attracted through aligning to, you know, expectations from global investors, but also, you know, maybe potential differentiators in how communicating, you know, strategic integration of sustainability in your business. Yep, I see lots of sort of common themes here, but you know, I think these are all the kind of points that we'd really look to highlight as well. So I think these are great things to set yourself out clearly up front and to communicate these with your internal stakeholders as well. So I think, you know, sometimes reporting standards can become in the minds of our senior leaders maybe just a box ticking exercise, but I think if you can really convey and communicate these aims and objectives and get that agreed with your colleagues earlier on, you know, it can hopefully set you off on the right path to really maximize the benefits from this exercise. Okay, fantastic. Thanks everyone for sharing. I think you've highlighted a lot of what we would have recommended. So probably the only points that I would mention or highlight here from what you've said is, as you say, to really consider those different stakeholders that you might have and think about the audience for your reporting here. So in particular, with the ISSB standards, we're speaking to an investor audience as the primary user. So, you know, thinking about what your information needs are from your investors. And maybe any feedback that you have from them already about your reporting could be helpful to consider here. So perhaps they've already given you some indications of what they might like you to see you doing more of in your reporting. And also thinking about the future as well, I think is really important. So building into this disclosure plan and your objectives a longer term view to perhaps where you'd like to get to over the longer time frame, perhaps how reporting requirements could evolve. And, you know, looking forward in those disclosure requirements is quite key as well. But overall, I think a lot of you are thinking about, you know, just the right sorts of things here. So we'd encourage you to sort of take that away, document it and share it with your colleagues. Okay, so that brings us to the end of module 1. So thanks for taking part in that exercises to wrap things up. So I will now reshare the slide presentation and I'll hand back over to Bella, who'll start us off in Align. Thanks, Bella.
Thank you, Fiona. Okay, so now that we have introduced the initial concepts, let's dive into how to apply the ISSB standards, taking into account additional disclosures including any relevant geographical or sectorial requirements, as well as peer practices and your leadership's objectives. Okay, so in order to understand how to ensure your disclosures meet global baseline, okay, so we will look at two key concepts in this unit. The first and the main focus of this unit will be on how to apply the standards to achieve a global baseline for disclosure. Once we cover that, we will also discuss how additional disclosure fit. So to begin, let's focus on how to apply the ISSB standards as the global baseline. Okay, so let's get started on the first core content area, governance. This includes aspects that relate to the governance body in your company and how management is applied. For each of the core content areas, we will discuss questions that you could ask in your company to start identifying the information that will support some of the disclosure requirements. For example, as part of a gap analysis. So if we look at governance and management requirements, we can see that there are several that are fairly qualitative. For example, which bodies are responsible for the oversight and the management of processes, controls, and procedures of sustainability-related risks and opportunities. And for example, is management responsibility delegated to a specific role or committee? And you can also ask how and when do they get informed about sustainability-related risks and opportunities? How these issues inform strategy, decision-making, and risk management. This could include setting targets to manage sustainability-related risks and opportunities. And also we can ask whether progress against these targets links to executive remunerations. So for more information, you can make use of the ISSE checklist tool, but remember it's not a replacement for reading and using the full ISSB standards. Okay. So let's look at an example. Over to you, Lois.
Thanks, Bella. So this example is from the Integrated Report 2024 of a company called Yara. And Yara is a global crop nutrition company headquartered in Norway. They've got 17,000 employees and they operate in 60 countries. So what we see in this diagram is a highly integrated model for governance. And it shows that responsibilities for sustainability in the light green boxes in the middle, we can see that those responsibilities are embedded across various business functions, including risk management, health and safety, environment and quality, human resources, global climate and energy. So a very integrated model. The arrows that you see are used in part to explain how information flows between different parts of the governance bodies in the organization. The other thing to note from here is the reporting line. So the Sustainability Governance team have a direct reporting line to the Chief Financial Officer, and they're responsible for sustainability performance and reporting. So there are multiple governance models to choose from. The ISSB standards don't tell you which governance model you must use. That is for the company to decide. But it's important that your company uses a governance structure that's fit for purpose and suits the particular needs of your company. And in this case, we can see that the reporting line of the sustainability team is to the CFO, and he or she in turn reports further up to the board of directors. Let's look at another example, a different type now. And this is from Toyota. It's from Toyota Industries annual report, and it's showing disclosures about the Sustainability Committee, who chairs it, who are its members, what are its agenda, and so on. In the report, just to let you know, there's also a QR code that goes with this that actually connects readers. So going back to the principle of connectivity to the company's sustainability policy, so we can see the connections between the governance model, the sustainability committee, and the company's sustainability policy. And within the report, of course, there is a diagram of the wider governance structure. So we can see how the Sustainability Committee that's described here, it fits in with the overall corporate governance structure. And it tells us that the Sustainability Committee described here is one of the business execution committees that reports direct to the president and to the board of directors. So in this example, we can see how frequently the Sustainability Committee meets, once a year or as necessary. We can see that the Sustainability Committee is chaired by the executive in charge of enterprise risk and compliance management. So a bit different to the reporting line to the CFO we saw in the example we had before from Yara. We see who the members of the committee are and that they're very cross-functional. They come from HR, accounting, technical executives, and so on. And also we can see the agenda. So what is it that the actions that the committee has taken? They approve action plans on sustainability. They determine the direction of the company's approach to sustainability that captures the opinions of stakeholders and social trends. And they revise the sustainability policy. So those were our examples about governance, and with that, I'm going to hand over to Fiona to take us through strategy.
Great, thanks so much for that, Lois. So getting started now on strategy, hopefully those governance examples have hoped to make that aspect fairly clear for you. So strategy, as you probably see here, has a few more aspects of disclosure to it compared to governance, but it's also really where I think companies can start to see the benefits from sustainability risks and opportunity management and how to be better prepared for those issues. So as you can see here, there are 3 high-level areas that we focus on in strategy. And these are risks and opportunities, effects, and financial resilience or strategic resilience. And we're going to talk about each of those now in turn. So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability related risks and opportunities. So if we look first at the requirements relating to sustainability risks and opportunities, here are some of the questions that you might want to be asking yourselves internally to start your thinking on this. So when disclosing information about risks, information required includes describing the effects of the risks, the time horizons over which those effects are expected, and keeping in mind here that those financial effects could occur before the risk or opportunity materializes, or afterwards, or even change over time, as we discussed at the start of the session. And the last 2 questions on this list in particular look at climate change, and so they align with particular requirements from the S2 standard. So for example, investors also want to understand what types of risks and opportunities have been considered for climate risk. And this is where we often see companies using the categories that have already been identified in the TCFD framework, so physical and transition risks, which we'll talk about in a bit more detail later in the session. And both S1 and S2 standards here include guidance to support companies to identify and disclose those risks and opportunities. And they also, again, recommend making use of further industry-based guidance, including the ISSB standards, to help you understand the particular risks and opportunities of individual subtopics. So again, we know examples can be helpful to bring this to life. So let's have another example here. So this one, it may be a little bit small, but with all examples, we do recommend in the slide handout following the links to look at the actual report so you can zoom into the visuals in your own time and see the detail. But just to give you a flavour of this example from Mondi, so Mondi Group is a multinational packaging and paper company, and they have operations across Europe, North America, and Africa. In the left-hand extract, we can see which risks the company has identified as its principal risks and how those different risks align with 4 key categories. So they've identified those categories as strategy, financial, operational, and compliance. And they've also delegated a particular risk owner for each risk as well within their leadership team, which I think is helpful, connecting back to what we were talking about from the governance section earlier. And there's a lot more information describing the individual information about each of these risks as well in the report. And then if we look at the right-hand side of the screen, the second extract there, this is in particular the climate change risks and opportunities they've identified for their business. So as well as identifying those risks through an evaluation process that they describe in the report, Mondi shows as well the estimated financial impact ranges of these risks. They also provide the time horizons, including differentiating between when the onset of the impact might begin and when the full impact might be felt later on in the time horizon. And they then look at the sensitivity of those risks and opportunities in terms of likelihood into different climate scenarios. So introducing a few more concepts there that we're going to come back to in more detail about time horizons and scenarios there as well, but hopefully a helpful example. So as I started to mention there, another aspect of risk and opportunity identification that we need to consider here is thinking about what we talked about earlier on, really, in terms of time horizons. So you might remember we talked earlier that time can be quite a different factor when we're talking about sustainability disclosures. So let's be clear what we're meaning here by time horizons. So the standards ask you to identify within what time horizon any material effects are expected to occur. And definitions of short, medium, and long term can vary between companies and depend on many factors. So they can depend on things such as your business's investment and business planning cycles, your strategic planning horizons, maybe the lifespan of your assets that you operate or own, or even other factors as well. And so what's important to remember is that you do need to define your time horizons. So don't expect investors to know what short and medium term means. You need to provide a quantitative definition to help them understand that. And as we said, as long as you're justifying the rationale for the time horizons you select, relating to those factors we've mentioned there, it's acceptable to use the time horizons that make sense for your business and indeed for your existing risk management processes as well, where relevant. So we'll move on now to look at the second group of disclosures in the strategy category. So the first section there was around identifying risks and opportunities. And the next set of disclosures here is thinking about where you've identified that a risk or opportunity could reasonably be expected to affect the company's prospects. You then want to consider exactly what that effect is and where it will occur in the business. So to start tackling the disclosure requirements of the standard, companies might want to start asking themselves questions such as beginning to describe what are the effects, understanding the responses that they have planned for mitigating or adapting to those effects. And again, another example I'm sure will probably be helpful to show how one company is approaching this. So here we're looking at the global chemical producer BASF's 2024 annual report. So again, just a short visual to summarize some key things that sit behind the information in their report. So here they illustrate some of the projects that form part of the company's sustainability strategy called Winning Ways. And this is really used to indicate how they're showing the effects that sustainability issues have on their business model and their value chain. So their strategy includes supplying companies with products that contribute to sustainability through the use of the products or through reducing their carbon footprint from the products they choose. And the company is also actively prioritizing projects where they see rising demand from customers and potentially a willingness to pay more for sustainable products. And they're also looking at transformation products that support the company's overall license to operate. And among other things, the company is investing in renewable energies to operate their plants, which you can see under the own production panel in the extract here. And then in the third area, kind of downstream value chain responses, they're talking about their triple S activity, which is the sustainability solution steering. And this is all around how they're streamlining their company's portfolio and supporting the delivery of their global sustainability targets. And in the commentary that we have alongside this diagram in the report, the company also says that it wants to achieve 10 billion euros in sales revenue by 2030 from products contributing to a transition to the circular economy. So you can see there really how they're starting to integrate that opportunity they've identified and speaking to what the potential financial effects for their business could be over a longer horizon. And I think this example also really illustrates how, those effects can be felt across a value chain. So the company is connecting between what it does within its own operations, but also how it needs to work with upstream and downstream partners to achieve those opportunities that it's identified. Okay, so some of the kind of obstacles that we hear from companies that they might face when they're reporting on these effects is to think about the detail that needs to be disclosed. And so in that example we just looked at, we were showing you mostly qualitative information and qualitative disclosures, but what about quantitative information? So under the ISSB standards, a company is required to disclose both quantitative and qualitative information about those current and expected financial effects of a sustainability-related risk or opportunity. However, the standards do also set out criteria for when only qualitative information is required. And so there's a few different instances here that you'll see summarized on the screen. So for example, a company may only use qualitative information for these current and anticipated effects if it can't separate the effects of a climate-related risk or opportunity, perhaps from other effects or other types of risk. Secondly, if there's a high level of measurement uncertainty that would prevent it from being able to quantify this issue. And finally, if the company itself doesn't currently have the skills, capabilities, or resources to provide that quantitative information. So that brings us on then to the last part of the strategy component. So in the first part there, we looked at the identification of the risks. We then talked about the effects that could be seen from those issues. And finally, we want to think about resilience. And so this is really about how companies are preparing for uncertainties under potential different futures. And so this gets into the practices and processes that the company has in place to make strategic adjustments and consider its long-term resilience. And so disclosures here are thinking about what types of assessment have been used and how they've been employed. And so at the heart of it, resilience disclosure is asking the company to assess its climate resilience and think about the key inputs and assumptions that have been used in any climate scenario analysis that has been undertaken. So we'll dive deeper into scenario analysis in a moment, but some key questions that you can consider asking internally when you're starting to disclose this information are focused on thinking about your company's capacity to react or adjust to uncertainties arising, and how different scenarios are being used to test this. So we'll look again at a couple more examples here of how this is being disclosed in practice. So the first example here is from Stora Enso, and they're a Finnish and Swedish forest products company. And in this small diagram here, they show us what their sales are likely to look like in 2030, projecting potential future growth and contribution to their business sales from what they've identified as these different strategic growth areas relating to sustainability. So we don't have the numbers here per se, but we do have an immediate picture of where they're anticipating that actually there's a real strategic opportunity for them here. They also provide details about their company's long-term vision and the recent transition to what they describe as proactively repositioning their businesses from just being a pulp and paper company to a renewable materials company, and ultimately by doing so, ensuring their own future resilience. And so this gives a sense of how they're hoping to expand and to grow into these new areas and perhaps offset what they're expecting to see in terms of potential declines in revenue from their traditional business services. And our second example here, which is quite small, I appreciate, so it's one again to maybe take away and read, but just to give you a flavour of what is talked about. Solvay is a Belgian multinational chemicals company, and here we wanted to highlight in particular how they've disclosed the financial effects of their risks and opportunities. So they've been quite transparent as well in their reporting about the estimates they've used and how they've conducted their scenario analysis. So if you're using a tool like scenario analysis, investors need to understand how you've used it. And you can see here that they note the assumptions that they have used, which scenarios they've selected, and which parts of the business they've assessed. And then in the second part of the disclosure in the table, they report the particular financial impact drivers that they have identified. And they use a sort of qualitative ranking scale from -3 to +3 to indicate the sort of potential direction and magnitude of the financial effect for the different risks they've identified. Okay, so hopefully that helped to bring that to life, but just to test what you've sort of gained from some of that content here, I've just got a quick quiz question to come back to something I talked about before relating to qualitative and quantitative information. So you've got more than one option available to you here. You can check more than one choice if you think there's more than one valid answer. But it's just to ask what those reasons are that a company may be disclosing only qualitative information or a mix of qualitative and quantitative information about financial effects. So take a moment and let me know which you think are valid reasons under the IFRS standards for disclosing quantitative information. Okay, see the numbers going up steadily. I'll just give everyone a few more seconds to have a think about that. Okay. 5 more seconds and then we'll see what everyone thinks, but I think almost there. Okay, great. I'll end the poll there and share the results. And it looks indeed like most of you got that absolutely correct. So indeed, the top 2 options there are considered valid reasons for disclosing qualitative information. If you can't separate it from other effects or if there's too much uncertainty to measure. The final option, of course, is not correct. So the reporting is particularly looking for transparency and balance about both negative and positive financial effects. So a company is expected to provide quantitative disclosure if it has that information, because obviously it's important to share negative information that you might have identified, as it would be for any risk type under reporting standards. And you'll see in that example from Solvay that I shared with you before, they did indeed provide indications of both positive and negative areas of financial impact, so provided that balance. Okay, thanks for participating there again, everyone. That brings us now back to Lois for some climate aspects of some of these areas in particular.
Thank you, Fiona. We've looked at the governance requirements today in the ISSB standards and the strategy ones. So with governance, the requirements in S1, general requirements, and those in S2, climate, are very, very similar. There's no specific additional requirements for climate. However, when disclosing information related to strategy, there are additional requirements in S2 regarding climate. So we're going to have a quick look at those. Now, the title here is from TCFD to ISSB, but don't worry if you're not using TCFD. This is really just a list of things that you need to take into account in S2 and that are additional to the types of requirements we see, or different from the requirements we see in S1. So the first thing is that IFRS S2 requires a company to refer to and consider the applicability of industry-based disclosure topics. Now, you can find those topics in the industry-based guidance that's available on the ISSB website, and those topics help you to identify climate-related risks and opportunities that are likely to be most relevant for the sector or industry in which you operate. Secondly, S2 requires information on where in the business model and value chain of the company risks and opportunities are concentrated. So is there a particular asset that is vulnerable to physical risks, for example, or is there a part of the value chain that is particularly susceptible to climate risk? Thirdly, S2 requires detailed information on the effects of climate-related risks and opportunities. For example, the effect you might want to disclose information about how the company has responded to or plans to respond to the identified risk and opportunity. Or perhaps where there's a transition plan, which we're going to talk about in a moment, whether the company has set targets as part of its transition plan. In providing disclosures about the current and anticipated effects of risks and opportunities on a company's financial performance, position, and cash flows, S2 sets out criteria for when quantitative and qualitative information is required to support the disclosure. And in particular, what you'll find is requirements that set out when you can or you're permitted to provide only qualitative information. And that would be, for example, where the company cannot separately identify the effect of the risk or opportunity, or where the measurement uncertainty is so great that it wouldn't make sense to provide the quantitative information. Then we come to the next point, which we're going to talk about a bit more later, which is that S2 says that a company is only required to use all reasonable and supportable information available to it at the reporting date without undue cost or effort, or can use an approach that's commensurate with its own circumstances in specific cases. And that's recognizing that some of these requirements can be quite difficult to conform with. So this is what we might describe as an easement in the standards. We've talked a little bit about the use of climate-related scenario analysis that must be used by the company in assessing the business resilience to climate-related risks and opportunities. Just to let you know, S2 does not specify which or how many scenarios are to be used for that scenario analysis. That is for the company to determine based on its own circumstances. And finally, the S2 does require information about the company's resilience, including things like any specific areas of uncertainty the company has encountered in undertaking its resilience assessment, details about what is the company's capacity to adjust and adapt its strategy and business model given the resilience assessment, and also details of how and when climate-related scenario analysis was carried out. So these are things that you need to take into account if you're already using TCFD or if you're starting on S2. Let's move now to look at transition plans, which I've just mentioned. So S2 requires a company to disclose details of any climate-related transition plan it has. But note that there's no requirement to have a plan, but if you have a plan, you have to disclose information about it. So what is a transition plan? Well, it's defined in S2 as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy, including, for example, greenhouse gas emission reductions plans. So what are we to take from that definition? Well, as an aspect of the company's overall strategy, the transition plan or the climate transition plan should be aligned with the company's overall strategy, including the business case and motivation for the transition, the types of decarbonisation levers that are most economically and technologically feasible for the company to use. So there should be alignment between the climate transition plan and the company's overall strategy. Secondly, there should be alignment with the science on climate change, so including what science says about requirements for reaching net zero or carbon neutrality, and alignment with Paris goals. They should be taken into account when developing the transition plan. Thirdly, the transition plan should develop long-term goals with clear mitigation and adaptation activities to achieve those goals identified, as well as the types of interim milestones that must be achieved along the way to the long-term goal. The transition plan should be transparent about the things on which it is dependent for success, any risks or challenges that might affect the achievement of the plan, and an explanation of how residual or unabated greenhouse gas emissions will be treated. And this transparency is important because by definition, the transition plan is going to face uncertainties. So these types of disclosures help the readers understand the uncertainties. The plan should also follow sector-specific pathways because the transition is going to proceed along in different ways for different sectors. We're going to have a look in a moment at some resources that help us understand sector-specific pathways. And finally, companies should consider how the transition plan will be evaluated by investors and other readers, and make sure that the transition plan has the hallmarks of credibility, which have been set out in various resources. So let's have a look at some of these resources now. So I should just say there are lots and lots of resources on climate transition planning, and these are just a few. In the triangle on the left-hand side, we can see the IFRS sustainability standards that ask for disclosures about climate transition plans. Next up in the triangle is the work of the Glasgow Financial Alliance for Net Zero, and they have a number of resources which we can see in the middle of the screen that set out the expectations for the pathways of the transition in different sectors and in the real economy and in financial institutions. Thirdly, and some of you have mentioned that you use this in the chat, I see, there's the disclosure framework of the Transition Plan Task Force. It's now been taken into the IFRS Foundation as one of their resources. And that sets out how to make disclosures about transition. But the triangle on the left shows that each of these types of resources and each of these organizations builds on each other's work, supports each other's work, is mutually supportive. So, yes, lots of resources there to help you with transition planning. Now, you'll be glad to hear the next thing is we're going to take a break. A 5-minute break, so do take this opportunity to have a drink, a stretch, think about any questions you'd like to ask us in the Q&A box. We're going to play some relaxing music for you, and we'll see you back here in about 5 minutes. Welcome back, everyone. I hope you had a chance to refresh and get ready for the next part of our presentation on the ISSB standards. And now we're going to look at the content requirements on risk management. So you can see from this slide that this category of disclosures requires report preparers to disclose information about their processes for risk management, for sustainability related risk and opportunities, as well as how those processes fit into their overall risk profile. So when you're thinking about this, the sorts of questions you might start to ask yourselves are: what processes and policies are currently being used to identify, assess, prioritize and monitor sustainability related risks and opportunities, and are they integrated into your overall risk management process? So to go into a bit more detail, you might want to think about the types of inputs and parameters used for risk management, the criteria used to assess the risks and opportunities. So it could be the nature of the risk and opportunity, the likelihood or the magnitude, might be other types of criteria that you use. What is the monitoring process for keeping track of the development of sustainability related risks and opportunities? And have there been any changes in your processes since the last reporting period? Now, of course, the company may already have a risk management process. What we're going to look at a bit later is whether that process is fully suitable for assessing sustainability related risks and opportunities, which often materialize over different time horizons and have different characteristics. So just to reiterate, this part of the content requirement is very much about disclosing details of the processes you use for risk management. So let's have a look at some of the climate-specific considerations about risk management. And again, the title here does say from TCFD to ISSB, but these points apply whether you're using TCFD or not at the moment. They are particular to ISSB. So if you are using TCFD, the good news is that the S2 requirements are broadly consistent with TCFD, as we've seen earlier. But IFRS S2 does ask for information about input parameters used to identify risks, whether and how a climate-related scenario analysis is used, which scenarios you've used, and whether the risk management processes have changed. Similar considerations apply to opportunities and how the assessment of opportunities is integrated into the company's overall processes. Let's have a look at climate-related risks in S2 in a bit more detail. Now, the important thing to note here is that we have definitions of what is meant by climate-related risk, and these are very much based on the TCFD's definitions. So there are two main types of climate-related risk: transition risks that arise from efforts to transition to a lower carbon economy, and these are often categorized as policy and legal risks, technological, market, and reputational risks. We've got some examples of these in the middle column. They can include things like increased pricing of greenhouse gas emissions, enhanced reporting obligations, perhaps exposure to litigation risks, and costs associated with the transition to lower emission technologies, changing customer behavior, and uncertainty in market signals. The second type of risk is physical risks, and these include risks from climate change that can be event-driven. These are acute physical risks, or they come from longer-term shifts in climatic patterns, and those are chronic physical risks. So these types of risks, we have some examples in the middle. They could give rise to increased costs of raw materials because of physical risks affecting the availability and quality of those raw materials. Perhaps stigmatization of a sector, increased severity of extreme weather events and changing weather patterns that could have knock-on effects to supply chain disruption, could include things like sea level rise, reduced or changed water availability, biodiversity loss, changes in soil productivity, all of these types of physical risks. Now, in the final column, we see that both transition risks and physical risks can have effects on the financial results of a company in terms of cash flows, access to finance, cost of capital, and these financial effects could manifest over different time horizons, the short, medium, and long term. Let's have a look now at how climate-related opportunities are defined. These refer to potential positive effects arising from climate change for a company. The types of opportunities could come from from resource efficiency, from changing to different energy sources that are not so carbon intensive, products and services being developed to respond to new customer demands, the opportunity to enter into new markets. I think we're going to look at an example of this later, and the opportunity to improve the company's resilience. So we see some examples of these in the middle of the slide, some of which I've already described. You can differentiate yourself from competitors, that's an opportunity, or find new resources that are more efficient or more diversified to enhance your climate-related opportunities. And again, these all have potential financial effects over different time horizons, can affect the company's cash flows, access to finance, cost of capital, revenues, financial position, and so on. So let's turn to an example now. And this is an example from a company called the RS Group, and it's from their annual report 2024. RS Group is a UK-based distributor of electrical and industrial equipment. It's got global operations. The RS Group have analysed climate-related risks and opportunities for a number of years as part of their annual disclosures and have actually identified 10 principal risks in their annual report, one of which is climate change. And what we see in this extract is the physical risks from climate change. It's just a summary of their physical risk assessment. So this indicates that the most significant physical climate risks relate to the impact of extreme heat. See this in the first row of the example, and it's the impact of extreme heat on their distribution centres. And we also see that there's another physical risk, which is from extreme weather events and the potential to cause physical damage and disruption to their customer supply operations. In each case, in each of these two cases of risk, one from extreme heat and one from extreme weather, you can see that they give a description of the type of the risk. They tell us who is the business owner of the risk, what metrics they're using to monitor the risk, and also some of the initiatives that they've put in place to manage their response to the particular risks. And in the final column, this includes information about the investments that the company is making to manage the risk or capitalize on opportunities. So this example also shows how the risks are connected to the RS Group's overall strategic actions and wider business stakeholder groups. And you can see that through the use of these icons. In the first column here, we see the little wheel with a highlighted red section in the spokes, and we can see that there are little icons to to help the reader understand which stakeholders are most affected by the risk that they've identified. So let's go over to Bella now to take us through the next content element on metrics and targets.
Thank you so much, Lois. Okay, so now we will spend some time reviewing the disclosure requirements on metrics and targets in more detail, the final core content area of the standard. Let's start with metrics. Requirements on metrics are designed to enable investors to understand the company's performance in relation to its sustainability-related risks and opportunities. Preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by a third party, as well as the methodology. What is the method of calculation? What were the inputs? Are there limitations? And what assumptions are involved? And now let's, sorry. Okay, now let's move on to the second part of this category, targets. Requirements on targets are designed to enable investors to understand the targets a company has set to monitor progress towards achieving its strategic goals. So disclosures include whether they are qualitative or quantitative, and whether it is set voluntarily or by law or regulation. And the disclosures also include the metric used to set the target and to monitor progress towards its achievement, and also the baseline period from which progress is measured and the period to which the target applies. And also disclosures include what are the milestones and the interim targets, if there have been any revisions to the target, together with an explanation about the revisions. Yes, and it's time for a real-life case. So over to you, Lois.
Thanks, Bella. And here we have an example from a company called ArcelorMittal. It's from their 2024 annual report. And ArcelorMittal is a multinational steel manufacturing and mining corporation with a global presence. So here, the first thing to say is on the top right-hand corner, we see the title Climate Change and Decarbonisation. Now, we've talked before about the importance of connectivity, but also the importance of context. So here, the company is describing to us the context within which they set their metrics and targets. And that context is that along with safety, they have identified climate change as a top material sustainability issue for the company. And they also tell us about what they've achieved since 2018, and that's about a 46% reduction in CO2 that they've achieved through footprint and asset optimization in some of their most carbon intensive capacity. Now, just further down in that top right-hand panel, you can see the progress and activities related to decarbonisation that they've identified across 4 key areas. Because of time, I won't go through them, but the important thing here is that they have described the activities that are going to lead to decarbonisation and to which the metrics and targets relate. So the second one down is securing the resources for the transition, and this includes renewables and high quality metallics, and the company is also investing in its own renewable energy projects and breakthrough technologies in some cases. So let's turn now to the table at the bottom of the slide, and this is actually setting out the metrics here. So the metrics show us the scope 1 and 2 greenhouse gas emissions for the company in the first row, and then for Europe, so that it might be important for investors to understand the metrics in different regional contexts. So not only do they set that out for 2024, but they also show the trend from 2018. in some cases, they have adjusted their metrics. You can see this in the little notes, and that's to take account of changes in their portfolio in the 12 months so that they can compare year on year, taking account of those structural changes. We also see that they, as well as having absolute metrics in the top two rows, they report intensity metrics. So this is the CO2 equivalent intensity for steel and mining across the company and for steel in Europe. So there's quite a breakdown here of what the metrics mean and how they relate to different jurisdictions and different parts of the business. So quite a lot of information here about trends, about performance, and about the context in which these metrics and targets are set. So moving on now to the climate-specific considerations for metrics and targets, I think it's back to you, Bella.
Yes, thank you, Lois. So let's talk about some of the climate-specific considerations for disclosures on metrics and targets. So the TCFD framework included recommended disclosures, which IFRS S2 builds on and S2 as part of the required disclosures. For example, IFRS S2 requires disclosure of industry-based metrics relevant to a company's business model and activities. And also additional disclosures are required on GHG emissions, including separate disclosures for the consolidated accounting group and associated joint ventures and the information about the company's financed emissions. In addition, IFRS S2 sets out a Scope 3 measurement framework to provide guidance for preparing Scope 3 GHG emissions disclosures. While IFRS S2 doesn't explicitly require a company to disaggregate its GHG emissions disclosures by the constituent gases, IFRS S1 includes requirements on disaggregation that would result in the disclosure of the constituent gases being required if such disaggregation provides material information. I'd like to remind everyone that you can access more information on climate metrics in the ISSB's training tool on this topic. We will share the link in the chat, and you can also find it on the ISSB's website. And likewise, there are some additional disclosures compared to TCFD for targets as well. For example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed the target and whether the target has been validated by a third party. And the IFRS S2 also requires disclosure of more detailed information on GHG emissions targets, including additional information about any planned use of carbon credits to achieve a company's net GHG emissions targets. And S2 also includes additional requirements to disclose information about the approach to setting and reviewing each target, and how it monitors progress against each target, including whether the target was derived using a sectorial decarbonization approach. Questions on GHG emissions often come up in questions on metrics and targets disclosures, so we wanted to address some of these briefly. For those who might not be familiar with the different scopes, there are three kinds of scope of GHG emissions. So scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from your company's facilities or vehicles. And scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity you purchase. And the last one, scope 3, is all other indirect emissions that occur in the company's value chain. So from the standards, S2 requires a company to disclose its absolute gross Scope 1, Scope 2, and Scope 3 GHG emissions in accordance with the GHG Protocol corporate standard. Unless a jurisdiction requires a company to use a different approach to measurement. And if a company is using a different measurement method, there is a transition relief to use that method in its first year of applying the standard. And S2 also requires a company to disclose whether and how the company is using an internal price on carbon for decision making, and whether and how executive remuneration is linked to climate change. Okay, so let's look at another example on GHG metrics. Over to you, Lois.
Thanks, Bella. And here we have an example from a company called Enel, which is an Italian producer and distributor of electricity and gas. And it's showing one of the ways in which the company disaggregates or breaks down and explains its GHG emissions. So actually, Enel produces a greenhouse gas inventory, and I think it's about 30 pages long. I was just looking at it. So they do have a separate report for their GHG inventory. It starts by setting out the company's ambition to achieve zero emissions by 2040 and to promote the role of electricity as an energy carrier to drive the transition to a net zero global economy by 2050. And they have a decarbonisation roadmap with targets and so on. So in terms of the GHG emissions, all of that set the context, but here we have the greenhouse gas emissions breakdown by type or scope in the top right-hand column. So you can see that the breakdown is by scope 1, scope 2 location-based, scope 2 market-based, and scope 3. Now, location-based reflects the average emissions intensity of local electricity grids that you're tied to for electricity consumption, and market-based reflects emissions from electricity your company purchases and is based on the contracts that you enter into. So they've broken down the two different types of scope 2 accounting methods there. So in the first columns with the stripes in, the diagonal stripes, you can see the emissions for the 2022 base year. And in the dark blue solid columns, you can see the emissions for the 2024 year. So you can see the trend from 2022 to 2024 and the reduction. But you can also see that scope 3 emissions forms the most in terms of the quantity of greenhouse gas emissions across the three scopes. So quite a lot of information in a tiny diagram. Now at the bottom of the page, you can see the scope 2 emissions for one of the company's business lines. It's the power generation and other business lines. And again, we see that this is broken down between location and market-based emissions. And again, we see the comparison between 2024 and 2022 so that you can see the trend. So there are many other detailed breakdowns in Enel's 2024 greenhouse gas inventory. This is just a small example of how they break down their emissions by scope and the scope 2 emissions by business line. So let's have a look now at a Zoom poll. The question is, what is the objective of metrics in the ISSB standards? So you can select all that apply. Is it to enable report users to understand performance in relation to the company's sustainability related risks and opportunities? To understand progress towards targets, or to understand the company's assumptions for the future? Give you a moment to think about that. Right. Yes, we can see people participating well. I'm going to end the poll and share the results just for the sake of time. Now, the first two answers are the correct ones. I can understand why you might say that the objective of metrics helps the reader understand the company's assumptions for the future. That's true. But the reason for asking you the question in this way is to encourage you to read the standards themselves, because at the beginning of every one of the content elements, the standard sets out the objective. And in IFRS S1 and S2, the objective of the disclosure requirements on metrics are to understand performance in relation to the entity's sustainability-related risks and opportunities, and to understand the progress towards any targets. So although it might be that the metrics help us to understand the company's assumptions for the future, the standard refers to the first 2 points. So well done. Most of you got that correct. Let's move on now. We're going to look at the next part of the Align module. And this is about integrating disclosure requirements that you might want to make up in addition to ISSB disclosures. So we've talked about the baseline already, so I won't go into that in detail, but we know that the reasons you might want to report additional things in addition to the ISSB's baseline is that there might be local requirements that you want to or have to conform with. They might take the shape of listing requirements, or they might reflect policy objectives in the jurisdiction in which you operate. They could be things like information about tax cuts or subsidies for sustainable practices. Also, you might want to make additional disclosures about industry, particular aspects of sustainability, or to meet the information needs of stakeholders other than investors. So we know that there are jurisdictional consultations ongoing about the adoption of the ISSB standards. And actually, the last time we did one of these presentations, we heard from an ISSB member that there are about 35 jurisdictions that are adopting or taking steps to adopt the ISSB standards. There's dedicated support available from the ISSB as part of their regulatory implementation program, and there's a link on the bottom of the slide here if you'd like to know more information about the completed and ongoing jurisdictional consultations about adoption of the standards. So we've talked about this a little bit already, but to support these additional disclosures and to support what's known as interoperability, that is, to reduce duplication and improve efficiency of reporting, the ISSB works with a number of organisations. We've already mentioned that CDP has aligned their climate standard with the ISSB's IFRS S2 climate disclosure. Now, the greenhouse gas protocol is the protocol that must be used for measuring greenhouse gas emissions. And the ISSB works closely with the GHG protocol team, and they're actively involved in updates to the GHG protocol corporate standard. And if you look on the ISSB website, you'll see that there's a bit of an ongoing consultation about greenhouse gas emissions reporting and how to make that more streamlined and simple. We've already talked about the fact that GRI and ISSB are working closely together to align common disclosure requirements so that the reporting system can be more seamless. We've also covered the Transition Plan Task Force. And just to say that with the Task Force on Nature-related Financial Disclosures, the ISSB is considering how to build upon the recommendations of the TNFD. So let's go back to GRI just to let you know that on the left-hand side, the ISSB and GRI jointly put out a publication that compared GRI standards and ISSB standards on reporting GHG emissions, and they found, I think, quite a high degree of alignment, looking at scope 1, 2, and 3 emissions. And they have a collaboration, a memorandum of understanding to try to deliver full interoperability between GRI and ISSB standards. An example of this is the collaboration they have whereby the ISSB is looking at GRI's standard 101 on biodiversity to inform their project on biodiversity ecosystems and ecosystem services. And the IFRS Foundation is a convening partner of GRI's Sustainability Innovation Lab in Singapore. Now, maybe not so much for this audience, but of course we know that in Europe there is the Corporate Sustainability Reporting Directive, and that must be used by companies within scope according to European Sustainability Reporting Standards, ESRS. So the point of this slide is just to say that the IFRS Foundation work as closely as possible with the European standard setter, and they've already done a project to look at the degree of alignment between the two sets of standards on climate-related disclosures, and they find a high degree of alignment. Where there are differences is because European standards ask for additional requirements that are designed to help the information needs of stakeholders who are interested in impacts, not just risks and opportunities, so a wider stakeholder group. And the ISSB standards have additional requirements on things like financed emissions, although the consultation I just mentioned is looking at that at the moment. So a lot of interoperability work ongoing, and that also includes the integrated reporting framework. So we saw in a slide earlier that the integrated reporting frameworks, principles and requirements have been incorporated into the ISSB's work. And the integrated reporting framework is a complementary tool that can be used to support sustainability disclosures. The document on the left-hand side is a picture of a report or a tool that's being developed to help preparers to use the integrated reporting framework to support sustainability disclosure. It's got dedicated frequently asked questions, a mapping tool, and a getting started guide. But I think the most important point perhaps to make about integrated reporting is that it's underpinned by integrated thinking, and integrated thinking can certainly enhance the quality of a company's governance and thinking and approach to sustainability reporting. So I'm going to hand back to Fiona now to take us through a Module 2 summary.
Great, thank you very much for that, Lois. That's brilliant. And as you say, brings us to the end of Module 2. So well done, everyone, for making it this far with us. I think, as I mentioned earlier in the session, Module 2 is our largest module. So don't worry, we are well more than halfway through our session today, but lots to cover, as I think you'll agree, in a line, and probably where a lot of the thinking needs to be to move these things forward. So I will move us then into the module summary. So we'll take a minute now just to remind ourselves of what we've learned here. So we reviewed all 4 content areas of the ISSB standards. So governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these don't operate in silos. And we saw in the examples that Lois has shared with us there that despite having 4 separate categories of disclosure, of course, this information is all interconnected. And we also discussed how disclosure might go beyond the requirements of S1 and S2. So, for example, to meet the needs of different stakeholders, to meet regulatory requirements in your jurisdiction, or perhaps to meet other industry standards. And so what's important to remember here is that when you're doing this, is that the ISSB standards have purposely been developed to act as a baseline, and the building blocks approach therefore allows report preparers to add additional disclosures on top. But in doing so, it's also important to be careful not to obscure the requirements of S1 and S2, and to ensure that that investor primary audience is still served with the concise financially material information that the ISSB standards call for. Okay, so to wrap us up again, you've probably guessed we might be heading back into Menti. So we'll just reshare the link again with you in the chat if you wouldn't mind, please, Lois. But I'll just talk through a few points to wrap this up and introduce the exercise. So here we just want to reflect and align. You've heard a lot about the different areas you need to align with, what the content is. And of course, what we'd really recommend that you do is go away and undertake a more thorough gap analysis. And we've shared with you the SSE gap analysis toolkit that can support you with this. And the homework exercise as well can also help you to build this out. But to get your thinking started, we just want to take a moment to reflect here on, from what you've heard so far, what do you think the key gaps might be within your organization? So this could be about areas of reporting content, so particular enhancements that you need or new topics you need to report, but it could also be around your own reporting processes and interprets. Maybe perhaps you've been collecting data in a certain way or having a certain governance set up for initial reporting, and now perhaps there's possibilities of needing to evolve that to make it fit for purpose for the requirements of the IFRS standards. So of course, there might be many different areas that you're reflecting on here, but just take a moment to think about perhaps what's front of mind for you as the key gaps in your current processes or reporting that you'll need to address. So I will reshare the screen at this end so that we can see the responses coming through together. And thank you, Lois, as well, for resharing the link. See a couple of responses coming through. I'll just give everyone another moment or two to think about that, and we can start talking through a couple of those together. Okay, I see a couple more through, so let's have a little look, and I'll let the rest of you do some thinking whilst I talk a few of these through. So people have mentioned data gathering and data quality. I see mentioned twice or three times there, I think. Consistency. Exactly. I think as you probably have realized and already maybe know, when we're looking here at the much broader set of issues perhaps than you might have reported on in the past, and starting to think about how you can quantify sustainability risks and opportunities, the data needs are probably going to grow quite significantly. So thinking at this point how you can set up the right reporting processes to enable you to collect that. And I think it's great that several of you have highlighted quality here as an important consideration, because of course, as evolving topics, many of these issues, will have to build maturity over time. But as much as we can work towards ensuring that data is collected in ways that are consistent, comparable, robust, and balanced, and building, a process to assure that level of quality is really important. So I think it's understandable that several of you have highlighted that as a key area to need to develop your reporting. I see here someone's also mentioned around targets and progress. The data gathering process has certain opportunities. Sure. So targets and progress. So indeed, actually, if you can use the data that you gather to better understand how you can improve performance, maybe you can realize some efficiencies from better monitoring these things. That will certainly be very valuable, but of course takes a certain amount of data to know what targets to set, how to monitor that on an ongoing basis. And then I see changing of structure perhaps as well, and capacity building. Yes, maybe perhaps often, obviously, this might have started as being purely the work of a small sustainability team in the center of the business, but increasingly you probably recognize the need to engage your colleagues, perhaps to involve finance and risk in some of these assessments, and also to think about how you can embed capacity in your different business divisions as well is probably quite important. So I think that's very understandable. So I think trying to make the case now with your colleagues and leaders for those resourcing requirements and getting ahead of those issues can be really critical. So I see someone has mentioned the lack of scope 3 data as well, and maybe lacks of standard governance frameworks. So I think lots of kind of comments on the data side here. And I think I just see if I see anything a little different to highlight in particular. So I think someone here has mentioned around identifying and disclosing the risks and opportunities from climate change. Of course, that often is an area that requires, more specialized skill sets, and thinking about how you can really build that into your risk processes as well. So we talked through some of the key considerations for what you'd need to disclose, but would really encourage you to take away and look at some of the guidance in particular on this topic for how you can build into your risk processes how to assess these issues, because although often enterprise risk processes are kind of well structured and quite closely aligned already with what the climate risk assessment requirements are, some things perhaps, the time horizons that we've talked about already might need to be reconsidered and built into your processes to better enable you to assess those climate risks. Great. And someone's maybe mentioned about possibly needing to physical adaptations as well. Yeah, indeed. So where we've been talking there about impacts on your business model, impacts in your value chain, your strategic operating model, of course, actually thinking about how you can invest in resilience measures to mitigate that is really important. So yeah, I think thanks for everyone who's shared there. I think lots of useful thoughts, and I'm sure many will resonate with what you've highlighted there from different businesses. I think these are certainly common gaps, and what we just really recommend is to try and take away a little bit more thinking on that, and to try and structure your thoughts so that you have a clear sense of what your gaps are and how to sort of prioritize which ones are most critical to address as you move forward. So I think another few things we'd mentioned that probably organizations often struggle with and would highlight as something to consider early on is connecting between your financial reporting processes and disclosures and sustainability information. Whereas in the past, these might have been conducted somewhat separately in silos. Of course, as we're talking about with the standards here, the two need to be really connected, and the integration of that information into the annual financial reporting is also really key. So thinking about how you can bring that together is a really important thing to consider at this stage as well. So thank you for sharing those gaps. Great to get your sense of what those are. Encourage you to keep reflecting on those and take away to discuss with your colleagues. But that brings us to the full end of module 2, and I'll hand over to Lois, who'll start us on the implement module now.
Thank you very much, Fiona. So in the implement module, we're going to focus a bit more on how to make disclosures. You might have noticed that the ISSB requirements are very much focused on what to report, what you disclose. So we're now moving on to look a bit more at how these disclosures are to be done in our implement module. It's got 3 parts. The identify part will cover how to identify sustainability related risks and opportunities, and then we'll look at some of the evaluation processes you can use, and then we will look at how to integrate your ISSB disclosures with your existing disclosure patterns, profiles and processes. So first of all, identifying sustainability related risks and opportunities. Well, there is some guidance in the ISSB materials about how to do this. And the important thing to note is that the ISSB asks companies to provide material information on all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects. Similar in S2 about climate related disclosures. So, because we currently only have a general requirements and a climate standard, what would you do about risks and opportunities beyond climate? So the S1 directs companies to sources of guidance to support the identification of risks and opportunities beyond climate. So first of all, when identifying relevant risks and opportunities, the company shall consider the applicability of the Sustainability Accounting Standards Board standards, which you can find on the ISSB website. And these are sector-specific standards, as you know. So they will include disclosure topics and metrics that may be most relevant to the sector in which you operate. After that, a company may consider IFRS educational material. There's quite a long document you can look at on sustainability related risks and opportunities and disclosure of material information that's been quite recently published. Companies can also look at the CDSB framework application guidance, also available on the ISSB website, that covers social and a range of environmental issues, including water. They can look at industry practices and guidance and the materials of investor-focused standard setters like the integrated reporting framework. Similarly, these sources of information can be used to identify what type of information you disclose about the risks and opportunities that you have identified. Similar to before, same sets of information can be or same resources can be looked at. But in addition, when considering what type of information to disclose, you can use the GRI standards and European sustainability reporting standards as well. So this is really a kind of a thought process for, well, how do I identify risks and opportunities beyond climate, and what information should I report about them in the absence currently of ISSB standards on the subject? Let's look at an example here of the kind of risk identification process that's been used by a company called the Ayala Corporation, as reported in their 2024 integrated report. Ayala is a Philippines-based conglomerate. They've got lots of different activities in property development, banks, healthcare, technology, and so on. This example provides an overview, an extract of an overview of their risk assessment process. And it shows that the first step really they use is to establish the context. That's number one. But going back a bit, you'll see that the overarching approach they use is communication and consultation. So they communicate and discuss their risks, action plans, and management process at various stages in the exercise of risk assessment, risk identification, and they use the insights that they get from that to really inform the whole of their risk process, which is described in these 4 steps. The first of which is to establish the context. So what is meant by that? Well, the context considers both internal and external factors. So internal factors might be organizational culture, the organization's strategic objectives, sustainability targets, and so on. External factors might include sustainability megatrends, natural hazards, climate change, political, financial, legal, economic, and social factors. So they set the context, then they do their risk assessment by identifying, analysing and evaluating risks. They then decide how to treat the risk, what would be their recommended course of action to address the risk. And one of output from that is a risk treatment plan. They also tell us who's in charge of that part of the process, which is the enterprise risk management team. And then finally, they have a monitoring and review process. So 4 steps, all informed by communication and consultation, is the process used in the Ayala group. Then let's have another look at an example here. And this is an example from Nest's 2024 annual report. And Nest is a company based in Finland. It produces sustainable aviation fuel, renewable diesel and feedstock solutions for the chemical industry. So it's using science and technology to transform waste and other resources into renewable fuels and circular raw materials. this extract is from the climate section of the company's annual report, and it shows how the company has identified and described risks and opportunities in 2 different scenarios over a time horizon to 2050. The first scenario is called Net Zero World, and this is broken down into what the net zero world looks like on a global basis and what the net zero world looks like in the EU and North America. And they do this breakdown because economies might take action at a faster pace than others in some circumstances. In both cases, the company anticipates opportunities from growing demand for renewables and circular solutions. And on a global basis, they have opportunities to expand into new markets and sectors. In the EU and US, they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambition. But they do identify risks also in the net zero world, and those risks are associated with competition and the acceleration of new technologies. Then there's one other scenario they used. It's called Compromise Climate Target Scenario, and this expects that climate action will be slow and that global warming of 2.5 to 3 degrees could happen. In this case, the company has the opportunity to differentiate itself from others through its supply of renewable and circular solutions, but the risk is that the demand for those products is constrained. The final thing to say about this example is that in each scenario, the company gives an indicative financial impact, whether positive or negative. And, as you might expect of a company that's business model is focused on sustainable products, the most positive financial impact is in the net zero world scenario 2050. So again, a lot of information about the identification of risks and opportunities. Let's move on now. We won't go into this in detail because we've already talked about it, but the proportionality mechanisms in the ISSB standards recognize that identifying risks and opportunities can be a valuable but challenging exercise. And therefore, they require a company only to use reasonable and supportable information available at the reporting date without undue cost or effort, as we've already discussed. So what is meant by that? Well, reasonable and supportable information is specific to the company. So we saw that one of the examples looks at contextual information, but also looks at what's the specific risk to the company. It takes account of the external environment, as we saw with Ayala. It includes information about past events and current conditions that the company will know about, but also forecasts, like we saw in the Nest example, where they use scenarios to think about the future. And in some cases, the way in which the proportionality mechanisms can be used is specified by the ISSB standards. So, time to hand back to Fiona now for the next part of the Implement module.
Thanks so much, Lois. So as we've heard there, once those risks and opportunities are identified, companies need to then evaluate those risks and opportunities and think about their overall kind of financial effects from them, which of course we know can be quite a daunting aspect when you're getting started with it. So let's see if we can try and kind of demystify this for you a little bit here. So to help investors understand a company's resilience against climate risk, S2 asks companies to disclose information about the implications of climate change on the strategy and business model, and also how companies can adapt, and what their capacity to do so is over the short, medium, and long term. So using climate scenarios is a key aspect here, and really is the kind of focus of this aspect. So S2 doesn't specify which scenarios a company should use, but it asks that companies use relevant scenarios and that they provide information explaining how they've selected the scenarios and what the assumptions are that underlie those scenarios. It also gives guidance to companies on how they can decide which scenarios that they should use and what the different practices are that could be considered ranging from starting with kind of qualitative climate narratives to more complex statistical modelling. And overall, companies are asked to take an approach that's commensurate with their circumstances and that uses all reasonable and supportable information that's available to them at the reporting date without undue cost or effort. So again, we'll just take a quick example here, just to show this. I think with scenario analysis, it's hard to do it justice on a single screenshot. So definitely recommend looking at the report itself to get a better understanding of this. But this example here comes from Nestle. You're probably familiar with them, the Swiss multinational food and drinks company. And this output we see is their climate scenario analysis summary for physical risks, particularly relating to the potential impact of physical climate change on yields of their 12 key agricultural commodities. And this visual here, they looked under different scenarios, but this particular visual showcases an intermediate emissions scenario and 2040 projected changes versus kind of the baseline of 2022. And so the analysis kind of shows the changes that they might see from impacts, including heat waves, droughts, and water stress, which could then have a knock-on impact on the costs and the quality of some of those key commodities and could impact the overall stability of their supply chain. And they also then go on to summarize some of the outcomes in the narrative that accompanies this analysis and talks about how those different impacts in their business areas have been addressed, what perhaps they're doing currently to try and increase their resilience. And so they talk about, both the impacts on an individual sort of product area, but overall, what does this mean for them as a business in terms of how much they're investing in R&D to leverage science to improve crop yields, for example, and how they're also kind of engaging in advocacy to improve positions in these areas. So just a quick summary of what they have done, but as I said, recommend looking at their report for some more information. And so just to touch on a final quick point to wrap up this section, of course, we're talking here about future events, and anticipating the materiality of future events can, of course, be very challenging. So the IFRS S1 standard asks you to think about a number of different issues here to help with this determination. So I'll leave this list with you to look at in more detail in the handout, but in short, it's asking you to continue to evaluate these factors, to really be transparent about what those uncertainties are. So of course, it's recognized that there are uncertainties and that's completely natural, but really just what you need to do is continue to evaluate how much those might be affecting the analysis that you're providing and how you can continue to improve certainty where possible, but also just to continue to assess this each reporting period. So I'll leave that with you, as I said, just to think about a little bit further in your own time. But in the interest of time, I'll move on now and pass back to Lois for the next segment.
Thanks, Fiona. And in this last segment in the implement module, we're simply looking at the types of processes that you might create or adjust to support your sustainability disclosure. Now, the good news is that you are likely to have many existing systems and processes that you can use to support sustainability disclosure, even if you're new to it. But when looking at those existing systems and considering whether and how to use them, it's a good idea to undertake a gap analysis to see what you've already got and what might be missing from the process. You need to consider the suitability of your existing processes for identifying sustainability-related risks and opportunities and other aspects of disclosure. As we've talked about before, sustainability risks have different characteristics and materialize over longer and more uncertain timeframes. So how suitable are your processes and your prioritization criteria given those characteristics? Do you need new criteria in addition to likelihood and impact, for example, vulnerability and speed of onset? Similar considerations apply to the company's internal controls. Are they suitable for sustainability disclosure? Then importantly, who within the organization or outside can contribute to your sustainability disclosure exercises? What departments need to be involved? Could it be company secretarial, risk management, finance, HR? Some of the types of departments we've seen reflected in the examples we've looked at. Then, in considering your existing processes, what are the interconnections between them and with external factors, and how might considerations about the connections feed into your sustainability disclosure? What uncertainties do you need to deal with, and how might they be reflected in your processes? Do you need actually to develop a process for treating uncertainty and the circumstances in which you'll decide whether to make disclosures or not in the context of uncertainty? And finally, what resources might you need to put in place to develop your existing processes or new ones? And do you have to go through a change management or budget process to get those resources? So a few things to consider when you're looking at your existing processes and considering whether to develop new ones. Now, the homework, as you know, is to do with developing a disclosure plan. So let's think about what we mean by that. Well, a disclosure plan can be a standalone disclosure strategy or part of a wider disclosure strategy that takes account of all of the types of information you might put in your annual reports. We talk about a disclosure plan enabling you to take account of your narrative, take control of your narrative. Now, if you are required to use the ISSB standards or any other reporting obligations, of course, you must do what those requirements say. But lots of the requirements ask you about your strategy, the metrics you've decided to take, your governance arrangements, and the disclosure plan allows you to, rather than have a tick box exercise, make the disclosures very particular to your company and your narrative. It also supports the kind of internal collaboration we've already hinted at. It allows you to make a note of who is going to be involved, which departments, how is knowledge going to be shared, how a process is going to be connected, how a system is going to be used to prepare your information. And finally, and I think most importantly, the disclosure plan acts as a reference point and an audit trail, recording where and how judgments have been made about disclosure, what your processes will be, who's going to be involved, how uncertainty will be dealt with, where you'll source data, how data quality will be assured, whether and from whom you will have assurance of your disclosures, what a sign-off procedures. All of these things can be recorded in your disclosure plan. Let's have a look at a real life one now. And this comes from a company called Novo Nordisk, which is a Danish pharmaceutical company. It's quite a lot on this screen, so I'll just describe what it means here. The company has outlined the general reporting standards and principles that it uses. So it lists the regulations that it is required to use for its disclosures. It also lists the reporting standards and guidelines that have been taken into account. So there's quite a long list of them there. They report the time horizons that are considered for the preparation of sustainability reporting. They disclose what they have decided to omit or not. I think they have not opted to omit information here corresponding to intellectual property and so on. But the point about this is that they make clear to the reader how the report has been prepared, based on which standards, which decisions, which principles. They tell us the sources of estimation and outcome uncertainty, but they also tell us the way in which they have changed their preparation and presentation approach in certain circumstances, and when they have made restatements if they have found reporting errors. Now, the final thing to say about this is it's a really good idea to get this type of thing agreed before you start your reporting cycle, because it just gives you that stable foundation on which to start developing your disclosures. Let's do a Zoom poll now, and you can only answer yes or no here. And the question is is a disclosure plan required by the IFRS Sustainability Disclosure Standards? You can either answer yes, and you must disclose your plan, or no, but it's a very helpful tool. So I'll give you a minute to think about that. I can see a pattern emerging. Nearly 50% of you participated, so I'm going to end the poll and share the results. So 64% of you said yes, and you must disclose the plan, and 36% of you said no, but it's a helpful tool. Well, the correct answer is no. So well done to the 36% of you. I can understand why you might think it's a requirement, but there's nothing in the ISSB standards that says you must have a plan and you must disclose it. There are some requirements that ask you to disclose how you've done certain things like GHG calculations, but there's no requirement to have an overall plan. We're just recommending it as part of this training because we do think it's a really helpful tool. So I can quite understand why you had that answer, but just to clarify, no requirement to have a plan, but we think it's a good idea. So there's one more Zoom poll now to do before we get to the Module 3 summary, and we'll just zoom through this a bit quickly. I think you know the answer to this. A disclosure plan can help a company to select all that apply, take control of its narrative, support collaboration, knowledge sharing, act as a reference point and audit trail for disclosure, or skip full disclosure as prescribed by the ISSB. Sorry to run through these a bit quickly, we're just slightly behind time. So as long as I can see a pattern emerging, there is. I'm going to end the poll and share the results. Of course, you're quite right. It is the first three things that apply. A disclosure plan, if you have one, is not an excuse to skip full disclosure as prescribed by the ISSB. If you're required to or choose to, you must still do that. So well done. Majority of you had that exactly right. And I'll hand back to Fiona for the Module 3 summary.
Great, thank you for that, Lois. So yeah, just to recap very quickly on Module 3. So we've talked about a few different key areas there. So interconnection and connections between reporting being the first one. And so just to continue to highlight the importance there of thinking about how to connect between your external and internal environment and your different risks and opportunities. Secondly, we talked around risks and opportunities and being consistent with your assumptions. So trying to year on year use similar assumptions so that there's comparison, and being transparent about what those assumptions are is really important here. And finally, as we've talked about, maybe some of this data is quite new for you. Maybe you're going to have to collect new things, but actually some of it might already exist in the business, or you might be using it for different reasons. So making sure to build from what you already have and avoid starting from scratch as far as possible is definitely helpful. Okay, so I'm going to move quickly into the exercise just to give us a few minutes. I see some of you have already responded. So we want to just dive straight in, I think, to your answers in the interests of time. So the reflection question here was just to get you to think about the existing kind of processes and systems that you have in your business that could potentially support you here in building out scenario analysis, in understanding risks and opportunities better. So of lots of different systems at play in different organizations, just a moment to reflect on what those might be for you. So I hear people mentioning here financial reporting systems, maybe looking at those used in your supply chain, perhaps environmental monitoring tools, maybe stakeholder surveys I see as a good point as well. So thinking about indeed, so maybe in your financial reporting systems, you have relevant metrics here about energy costs and maybe emissions or resource consumption that very much have an interconnection to sustainability, as is mentioned. Another person here has mentioned around health and safety environment logs. I see mention of customer data as well, customer and employee surveys. Ooh, remote sensing and satellite imagery is really relevant, of course, if you're looking potentially at climate risks or monitoring environmental degradation and change. So that's fantastic if that's something that you want to explore. And there are plenty of tools, as you're probably aware of, out there that aggregate some of these sorts of data sets that you can start by using, industry research and proxies, perhaps, even if you don't have your own organizational data. And then I see talking about waste systems, environmental management, maybe HR data as well, as you say, if you're looking at social issues regarding labor practices. So I think that's a good point to highlight as well. A lot of that people information is very relevant to social risks and opportunities, of course. And someone here has mentioned also, adapting systems. So if you already have those financial and operational reporting systems, maybe you do need to collect new things, but as this person recommends, trying to adapt those existing systems to help you collect that is a really good suggestion. So brilliant. Thank you everyone for sharing. In the interest of time, we'll move into the next section, but obviously feel free to continue to reflect on this in the background. Now, I'll leave that question open for you to do so. But in the meantime, I'll hand back to Robert now from the IFRS team, who'll start us into the Communicate module.
Yes, great. Thank you. Thank you, Fiona. And hello, everyone. We'll be now moving to the last module of this training. I'll be talking about communication, so how to communicate with investors, and then we'll be focusing on when and where of the disclosure of sustainability-related information. Then we have 3 units in this last section. We're talking about the location and timing, efficiency, and confidence. And to get us started, first, we'll look at the location and where the disclosure should appear. In here, let's then, before we get into the details, we have this, let's just zoom out a little bit and look at the holistic reporting package, which supports this dual purpose reporting module. So on the one hand side, where IFRS and the FSB standards address the investor needs, and GRI standards expand on sustainability metrics relevant to broader societal concerns. And together, these 2 frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader societal expectations. So the requirements of ISSB standards are about information to report are based on existing sustainability reporting regimes, focus on investor information needs and aspects of financial accounting standards. And GRI is what I mentioned. It's more it's broadening this perspective. So what is important here to remember that ISSB and GRI reporting standards share some content requirements on what to report, for example, but ISSB standards are focused only on investor information needs. So what it's also important, and this is aligning with the IFRS Foundation mission, which is to bring the transparency, accountability, and efficiency to capital markets around the world. So both organizations take different approach to defining materiality, but they're not competing. And I think that's a key message here. So the GRI approach is set out and understood already among sustainability practitioners. And the IFRS approach is then familiar to accountants and relies heavily on management judgment. And so that aligns with the existing corporate risk management processes. So together, these frameworks enable companies to meet growing demand for the transparent, consistent information, as I mentioned before. So, and then we can see that it can be interaction between the 2. And so the simple example might be that for or double materiality, which is relevant for GRI, and when the double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose for investors. Right. So then we're moving to the next slide here, and then revisiting material information once again, just to have a clear understanding what is being defined as material information. So material information is different, has different definition for different reporting standards and audiences. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. It's a definition from the IFRS S1. So once the company has identified, which is the first step, those risks and opportunities, it can determine what information to provide about those risks and opportunities. And then here comes the materiality definition into the play. So definition of material information used in S1 is based and aligned with definition found in accounting standards. So that's information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. In other words, ISSB standards seek to identify disclosure of key information that matters to investors. So the entity determines what constitutes a sustainability-related risk or opportunity based on its facts and circumstances. And entities often have well-established processes already for identifying, assessing, and responding to sustainability-related risks and opportunities as a part of their management of their businesses. We'll be moving to the Zoom poll, and just to make sure that you have the right understanding of what we covered just now. So where the question is what information should be disclosed in the annual reporting when applying ISSB standards, in 3 options, A, B, and C. When omitting the information, could reasonably be expected to influence investor decisions. B, it could reasonably be expected to affect the company cash flows. C, exemplifies the value of the leadership team. And I see information coming in, and yeah, most of you are right. Indeed, the correct answer in this case are A and B. So the material information is not about values or the features of the leadership team. It's about the matters which are the most relevant for the investors and decisions and cash flows. All right, let's move to the next slide, and then we'll be talking about the location where to report for ISSB. Disclosure under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But S1 does not say where in the reporting package the information shall be provided. This is designed to allow jurisdiction-specific requirements on the location of reporting. The most important factor to consider here is to ensure that sustainability disclosures are provided as a part of the same reporting package as the company's financial statements. So sustainability disclosure must be provided at the same time as the related financial statements, cover the same reporting period, and be authorized by the same body or individual authorizing the financial statements. And now we're moving to the real example and then how the application of this principle can be done in practice. Over to you, Louis.
Thanks, Robert. This is an example again from Ayala's integrated report. They're the Philippines-based conglomerate, and this is based on an integrated reporting framework diagram that shows the inputs of capitals to the company's value creation model and what value they create. So as far as the value creation framework is concerned, you can see the types of capitals that are inputs to the company's business, and you can see the value generated in the 3rd column. The things to point out here, though, about if effective communication are that this acts as a kind of an index to the company's, to the value creation part of the company's annual report. And it shows you where contents can be found. So in the middle orange circle, you can see the page numbers of where to find information about the company's outlook, their material topics, the stakeholders to whom they report, their strategy and their business activity. If we're talking about effective communication, the other thing to note from this example is the use of icons. So if you look to the right hand there and you see focused execution, there is a little icon associated with it, which is a little skull with a wheel and arrow in the middle of that. And that relates to one of the company's strategic pillars. You can also see it right in the middle of the orange circles there. So the effectiveness of this communication is that we have in one diagram an overview of the value creation model. We have an index and we have a sense of where there are connections between the strategic pillars and what is being reported. But of course, these examples we're giving you come from PDFs, and we know that there's also going to be a move to digital reporting, which is what Robert's going to describe next.
Yes, indeed. Thank you, Liz. Yeah, we'll be now talking a little bit about technology and what is the impact and the role in the disclosures. So definitely, this is the emerging consideration, and the corporate reporting is then moving, as Liz mentioned, from PDF reports towards information on web pages with structured data sets, such as those used by stock exchanges. And the IFRS Foundation in this context has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the standards. So the taxonomy is not a separate requirement. A digital taxonomy provides the common elements or tags needed to make your sustainability disclosures machine readable. And this makes it easier for the large data sets, like information from entire industry, and to bring them all together and to analyze them. So digital reporting has a number of benefits. It makes reported information easier to use for analysis. Data is structured the same way across businesses in a machine readable format. And tagging information potentially allows for automated checks for quality and consistency. So more and more data collection and management systems are compatible with digital reporting taxonomies, improving processing and reporting preparations. And tags can also have labels and descriptions in multiple languages. So then if you report your quantitative data in one language, someone speaking another language can also understand what it means. Right, and I'll be moving to the second unit of this module about efficiency. So following the discussion on location and timing, we need to now ensure efficient disclosures. And we added this to the training because a common comment we find from companies is that there is a growing reporting burden, but we hope that to highlight is when done correctly, efficiencies can be made to reduce the burden. So first of all, let's briefly talk about effective communication and what effective communication looks like and what is required. So often companies think that they just put all the information they have into a report that everyone will be satisfied. However, this would be against the core concepts, in particular for presentation. So it will be then worth it to helpful to ask following questions. Is the information you are disclosing clear and concise? And by clear, that might depend on the nature of the information. For example, whether it could be clear to present information in tables, graphs, diagrams, plus accompanying texts. And then concise. To be concise, disclosure needs to avoid boilerplate information, unnecessary duplication of information, and to use clear language. quality of information disclosed. Some preparers watching today might be thinking to themselves that they still don't see what is all the fuss about, and so perhaps the experience focuses on standalone sustainability reports, or they don't have much interaction with external audit. And to the accountants watching, I say be kind to your colleagues, help them understand the difference in rigor that is required in data collection, oversight, sign-off, etc. for financial statements. So that means, for example, disclosures include comparative information and are to be restated as necessary. Disclosures should avoid unnecessary duplication and cross-references as required. And cross-reference as required. Information has to be material, be connected and aggregated, all disaggregated appropriately. And I mentioned cross-referencing, so we'll be now touching this topic and what does mean. So you may already have noticed that there might be some overlap in disclosure topics. For example, you might have the same governance approach for all sustainability issues. So rather than duplicate certain information, you can use cross-referencing to enhance the efficiency of your disclosures. So cross-referencing to other reports is also permitted as long as the other report is available on the same terms at the end and the same time as the sustainability disclosure. The cross-reference information is assumed to become part of the reporting package. Cross-referencing shall be applied consistently and transparently. It shall not result in the information becoming more difficult to understand. And we have to bring a bit more light. We have a real example on that. And over to you, Lois.
Yes, thanks, Robert. And again, this is from ArcelorMittal, and it's their 2024 sustainability report, an extract from that. And it's an illustration of what cross-referencing can look like. There's many different ways to do this, but what they're referencing here is IFRS content elements and concepts with an Sustainable Development Goal index. So you can see down the left-hand column, they list the IFRS content elements and concepts, and we've been talking about these today. You'll recognize them: governance, business model, risks and opportunities, performance outlook, etc. And then in the our response column, what we can see here is where you can find information on each of these content elements. So they're telling you where the reference is from that content element. So there in the business model, we looked at the sustainability report. For strategy and resource allocation, you can see the executive statement, the business model in the 2024 sustainability report, and more information in the annual report and 20F. So one way, using an index to do your cross-referencing, illustrated in this example. Back to you, Robert.
Thank you, Lois. Right. And then we're moving to some mechanisms that can support that option. So we at IFRS Foundation have sought to apply a number of mechanisms to support preparers and to get started with their application of the standards. So first of all, one simple thing put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from the ISSB standards, accounting standards, for example. Secondly, many requirements in S1 and S2 are to be applied proportionally. So recognizing companies will have a range of capabilities and preparedness on these issues. So, for example, qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting date without undue cost or effort, or commensurate with skills, capabilities, and resources in a number of places. So, so that's the first thing. The second thing, the third thing is that there's a number of reliefs for the first year of application. And these are, for example, the companies being able to limit disclosures to climate only in years 1 and begin reporting on other sustainability-related risks and opportunities in the year 2. Companies also be able to provide annual sustainability-related financial disclosures with their next half-year reporting rather than at the same time of the financial statements. And also companies not needing to provide disclosures about Scope 3 emissions apply to greenhouse gas protocol standards to measure emissions if they are already using a different measurement approach or provide comparative information in their first year of reporting using S1 and S2. Another relief allows companies to include greenhouse gas emissions information obtained from companies in the value chain with a different reporting cycle. So yes, and these reliefs are then designed to enable companies to put in place reporting practices and structures to provide high quality decision useful information. Right, and then we have 2 Zoom polls, and then again, just to make sure you get a right understanding of the information covered, and that's the features of the information disclosed in accordance with the ISSB standards should be A, decision useful, B, material, C, misleading, D, comparable. And I think this should be fairly easy answer to question. And indeed, most of you are right. Yeah, the correct answers are obviously A, B, and D. The information disclosed should not be misleading. In the next Zoom poll, I'd like to ask you about the useful information and what does it mean. So is it A, relevant and faithfully represent what it purports to represent, B, comparable, verifiable, timely, understandable? Which of those are features of the useful information? And it looks like you did have a good understanding of what we discussed. And most of you are right. Yeah, all the answers A, B, C, D, and E are correct. In this case, these are all features of the useful information. Great. Thank you very much for the ones who participated. Now we'll be moving to the last section of the last unit, last section of this module, and then we'll look on how to ensure that users of financial reports have confidence in the data you're disclosing, as trust is essential component of sustainability related disclosures, and it's also of the growing concern over greenwashing. It's important in that context. So in one of the elements here we would like to talk is again, using comparative information. So that's an important trust builder in showing data and trends over time. And this is why ISSB standards ask for comparatives. Comparative information provides context, helps to indicate progress and underpin strategy and risk management. So metrics disclosed by a company might be redefined or replaced over time, or the company might change its method for estimating a metric. So in this situation, it is important for a company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant prior period figures. So also, occasionally a company reports might contain material errors. And in these situations, the company is required to restate these errors in the comparatives provided. So revisions or restatements are necessary only where there is a risk that the material information being omitted, misstated, or obscured as a result of not revising or restating the comparatives. So only in this case this should be disclosed. So, and again, information can be qualitative and quantitative. So one more thing to add here is that companies sometimes express concern with sharing information they deem to be sensitive, or that if shared could deplete their competitive advantage. And the ISSB standards in this case relieve a company from disclosing information about sustainability-related opportunity if that information is commercially sensitive. So this is a concern you have. There's a further detail you can read in the handout. Right, and almost the end of the training, and one important aspect to mention here in building the confidence, it's by providing the clear statement of compliance. A company that complies with all requirements in the ISSB standards, even the reliefs, is required to make an explicit statement of compliance. So there's also a guidance published in September 24 called Voluntarily Applying ISSB Standards, a guide for preparers, which then describes this topic in more detail. All right, so just to wrap up, there's a list of the things which are worth to remember. Please do work through the list. You can find in the handout slide deck, an additional slide in this section, which reminds you how to report effectively. And I do highly recommend reviewing that. And with that, over to you, Fiona, for the module 4 summary. Thank you.
Great, thank you, Robert. That's fantastic. So as Robert says, that brings us to the end of our final training module. So big thank you to everyone who stayed with us throughout this full 3 and a bit hours so far of training. We know that's a lot of time to listen in an online environment, so we do really appreciate your attention and engagement, and we hope a lot of this has been informative. But as we said, please do make sure to take a look at the handout in your own time for anything perhaps that we didn't get to cover in the detail that you might like to have done today, so you can come back to that. But just to recap a few key things from our final module here. So firstly, as we've said, being really clear on the audience and making sure that we're thinking about who we're reporting to fundamentally is an important thing. So being clear that the primary user for the ISSB standards is investors will really help to ensure that this information is right for their needs. We then discussed efficiency, and I think the key takeaway here is that less is more. So the objective isn't to overload your investors with information, which actually can be harmful because this could obscure the information that is required. So using the standards as you get started can be a good guide to make sure you're providing the information that investors need. And of course, that's the purpose of the ISSB standards fundamentally. And finally, we discussed report user confidence. And especially in the current climate of greenwashing accusations and legal battles over public statements, you want to ensure, of course, that your data is not only accurate, but that it's presented in a way that builds confidence among report users. And so the reporting plan that we've been discussing here can help you to do this. As if it's done well, you'll have the clear and documented process for reporting the data investors need. And as a quick reminder, as I see the question has come up again in the chat, you can access the handout for the slides and the homework exercise from our event web page. And I'll just ask Lois if she wouldn't mind resharing the link to that again in the chat with everyone. But just to wrap us up on this final segment, we've got a quick return into Menti. We'll just keep this quite rapid fire, I think, in the interests of getting everyone away on time and covering off some of the final points. So we've heard from Robert there a little bit about presentational approaches and how to make information navigable and using things like cross-referencing. But we'd like to hear from you, maybe a reflection on what you think some of the key ways that you can use to improve reporting navigation and connectivity are. So if you just take a little trip back into Menti again, we can quickly just review a few of your responses that I see have come through on this question already. So thanks for those who've got ahead of the question there already. So I see people have mentioned using comparable material information backed with assurance, including an index specifying page numbers and containing material topic details. Very good, yes. So someone also mentioned using clear structure and headings, having key highlights, interactive table of contents, of course, so you can click between those tables of contents and different aspects. Using a stakeholder-focused language as well is a good point to highlight. So making sure you're using the terms that they will recognize for these issues and that will resonate and help them to know what you're talking about. Avoiding that company-specific jargon and acronyms as much as you can. And then I think we've seen maybe using other stakeholder and customer platforms to share information with them. I think that's a very good idea. So bringing the information to them. So if we're using our annual report as the primary vehicle for investors, maybe some of your other stakeholders could have this information brought to them in other routes. So we've seen also maybe having interactive dashboards. We're using summary tables, visuals such as charts and infographics. Making complex data easier to follow and the report more engaging. Exactly. Always the challenge, of course, to distill and synthesize, but I think hopefully that's come through from a lot of the examples that we've shared. The examples that have really jumped out at us at the SSE and at IFRS to share with you are ones that have been quite visual and quite navigable. So whilst often there's a lot more supplementary detail that sits behind the visuals we report that supports the summaries they're providing, I think as a reader, we all know that those visuals and summary tables are very helpful. Excellent. Using consistent language and terminology, so straightforward language and avoiding technical terms. Yeah, I think it's obviously something I know we can all be guilty of in this spaces of jumping into the jargon, but remembering, of course, that your audience doesn't always benefit from that is very valuable to highlight. And maybe even having a glossary if you are going to need to use some technical terms, possibly on climate risks, for example, maybe having a little glossary at the back of your report could be helpful there. Lots of really good ideas. So thank you everyone for sharing those thoughts. I know those will be helpful for others in the training. So just to wrap up Menti before I cover a few concluding points, we want to just revisit that question we asked you at the start of the session about your comfort on these different areas that we talked on. So I hope we can come away feeling as though we've helped you to build your confidence on these areas. But yeah, let us know how you feel that you're doing now against these different areas that we talked about at the start. And of course, we recognise today is often just one step in the learning journey. And so we hope that some of the resources that we've highlighted and which we'll cover in summary at the end here can help you to continue to explore that on your own as well. But I can see the responses looking more positive there. So that's very encouraging to see a move up that scale. But I'll leave you to respond to that in the background, and I'll just go back to the slides now to cover a few final closing points. Okay, so we've mentioned a few times the homework exercise here, but just to recap on this, as we said, this is entirely optional, but we hope is a way for you to really continue your learning journey on this topic. We know that this interactive time we have together, whilst 3.5 hours is quite a long time, it's a so we'd encourage you to take away that draft disclosure plan assignment, and we hope you can help use that to put into practice what you've learned in the training. And so that can be downloaded from the event page at the bottom in the resources section, along with the slide handout at the link that Lois has shared with you. Additionally, you have some other resources that you can refer to continue your learning, and I'll just highlight a few of these in summary. So firstly, we have the IFRS Sustainability Knowledge Hub. As mentioned at the beginning, this hub is regularly updated with relevant resources and is really the go-to navigating point to access a lot of the links and resources we've shared from the IFRS today. So make sure to go to that Knowledge Hub from the IFRS. We'd also highlight, of course, the standards themselves as a key thing to continue to refer back to for the detail on the two topics. So, of course, going to the standards navigator to help you access those that we've shared the link to is important. Finally, just a few more things. So IFC, who are our partners on this training program, have some great resources here under the Beyond the Balance Sheet program. So this spans all sorts of issues relating both to sustainability, but also broader issues of corporate governance and broader financial and sustainability disclosure, tailored to several different audiences, including regulators, banks, etc. So make sure to check out these resources from the IFC too. And a final reminder, we touched upon these at the start, but the SSE has been working really closely with the IFRS Foundation in recent years to support exchanges and their issuers on this topic. So just in case you missed it at the start, a reminder of the SSE toolkit of resources here relating to sustainability reporting and the work of the IFRS that you can take away as well. So a big bravo and well done to all of you who stuck with us throughout this full 3.5 hours of training. As I've already said, we know that this is a long time to be together and there is a lot to learn. So we're really appreciative of everyone who stayed with us for your questions, your interaction and engagement throughout the training. It's been fantastic. And as a merit of your hard work, you can now receive a certificate for completion of the course. So to do so, you'll need to fill out the feedback survey that we'll be sharing with you. So there are two ways to receive this survey. Firstly, Lois will be sharing the link in the chat with you shortly to the survey. And secondly, in the next 24 hours, you'll get an email from Zoom, which will share the link again with you to the survey. And so in case you miss it here, you can also receive it in the next day from Zoom. Then what happens is once you complete that survey, we'll use those details to send you your completion certificate within the next week after you've completed the survey. So if you do miss any links or if you miss receiving your certificate, please make sure to check your junk folder in case it might have gone there by mistake. And sometimes we'd also recommend maybe using a personal email address if you know your organization has maybe some quite strong spam filters to block emails. Maybe using a personal email can be helpful to make sure you receive your certificate. So as we said, make sure you fill out that form at the link that Lois has shared with you, and you'll then get your certificate in the next week or so. But before we close, just a few final words of appreciation. Firstly, to the SSE's official supporters who make this work possible. And in particular for today's training, we'd like to thank our partners at the IFC and the IFRS Foundation, and particularly Bella and Robert for joining us today and answering your questions as well. And of course, a big thank you to the Armenia Stock Exchange, to Irina and her team and Maricia for your support and hosting us today. And of course, a final thank you to all of you who've joined us. We really appreciate your time and energy for today's training and wish you all the best with your efforts to adopt these reporting standards. So have a great day, everyone, and we'll close the session there. Thanks again.